Welcome and good afternoon to all the participants. Let me share this PowerPoint presentation with you. So, in the last three sessions, we have discussed and understood on a couple of things. We started with basics of accounts and accounting, and we discussed on the process of accounting. Then yesterday we discussed on the preparation of final accounts, in that trading account, profit and loss account, and balance sheet, also the appropriation account, adjustment entries, and a little bit of cost accounting also we discussed. So in today's session is focusing on the analysis and interpretation of financial statements. This is the next branch. So we have studied two branches now. The third branch is the management accounting. Management accounting branch.
So can you make the PPT bigger?
Deals with the financial analysis, understanding the financial statements in a better way using various tools.
Sir, your PPT is small.
Second,
yeah, can you make that below? You can
better,
see that
sir,
50. No. Yes, either presentation mode or little big.
Yeah,
yes, sir. This is better.
Okay, I can. Yeah, I'll put it in presentation mode.
Yes, sir. This is much better. Yes.
Yeah. So this management accounting deals with analysis and interpretation of the financial performance of the company. Management accounting starts when financial accounting ends. I had told this earlier also. Management accounting actually begins the moment the financial accounting ends. And yesterday we saw where the process of financial accounting ends. The process of financial accounting ends by preparing the final accounts. Once the balance sheet is tallied, that is the end point of financial accounting, and exactly that is where the management accounting starts. And just to make a comparison between financial and management accounting once again, financial accounting focuses on recording, classifying, and summarizing of the business transactions. And we saw recording is done through the journal, classifying is done through the ledger, summarizing is done through the trading P&L, appropriation accounts, and the balance sheet. But the management accounting focuses on analysis and interpretation. So let us swiftly understand what this analysis and interpretation means. Now we have a small exercise, very small exercise here, to understand the performance of companies. I have given comparison of two companies over here, company X and company Y. In the particular column, I have given net profits, that is rupees in crores is given. And let's assume these two companies are identical in all the respects, means to say these both the companies are in the same industry. Let's say that companies like if they are into IT, I'm sorry. If they are into IT, they are like TCS and Infosys. If they are into banking, say they are like State Bank of India and HDFC kind of thing. So it means to say that both the companies are identical in the sense they are in the same industry, comparable companies kind of thing. Now, this is the figure for one financial year, in the last one financial year. Let's assume like this. Company X has made a net profit of rupees 1,000 crores. Company Y has made a net profit of rupees 500 crores in one financial year. Now, I wish everybody understands meaning of this net profits. Now, if we have to look at this available figure and comment on the performance of the company, which company has performed better? The question to the participants, which company has performed better? Vote you participants. You can type your answers in the chat box. Okay, I get two different answers here. One, the first answer said company X has performed better. Another the person has said company Y has performed better. Okay, very interesting. Any other answers? So we got both actually, X and Y both. All right. Another example. I give another example here. Now we are not talking about the profits. We are talking about the investments. You know, investments is how big the company is, right? How much money is invested in this company in the form of capital, share capital, kind of a thing. Now there are two companies again. Both the companies are identical in all the respects. They are in the same industry, same sector, comparable companies, something like TCS and Infosys again. Now, these two companies have a different size. Now, see, company X has 20,000 crores of capital and company Y has 5,000 crores of capital. If you want to invest, if you are an investor or a potential investor, which company would you like to choose for investment purposes, X or Y? Question to participants. X. One person says X. So reasoning could be it's a bigger company, bigger is better. Somebody, Pooja Mullah, has said why. Probably this investor thinks that small is beautiful, so a smaller company is better company. So another person says why. Can I also ask what makes you say company Y? Any one of you? Why do you think company Y is a better company to invest in? So answer from either Pooja or from Manupriya. Why do you think company Y is better? If you want to speak, you're most welcome. You can unmute and then speak.
Hello.
Yeah. If you want to give answer, yeah, you can go ahead, Pooja.
Sir, I think that company Y will be invested 5,000 rupees, sir.
What do you want to invest in company Y?
Sir, in first example, 500 crores profit ಆಗಿದೆ ಸರ್ ಅಲ್ಲಿ. ಸೊ ನಾವು ಇದೆರಡು ಕಂಪೇರ್ ಮಾಡಿ ಹೇಳಿದ್ದು ಸರ್. 5,000 crores ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದ್ರೆ 500 crore ನಮಗೆ ಪ್ರಾಫಿಟ್ ಆಗಿದೆ. ಬಟ್ ಕಂಪ್ನಿ ಎಕ್ಸ್ 20,000 crore ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದ್ರೆ ಅಲ್ಲಿ 1,000 crore ಅಷ್ಟೇ ಪ್ರಾಫಿಟ್ ಆಗಿದೆ ಅಲ್ವಾ? ಅದಕ್ಕೆ ನಾನು
Okay, don't look at that information. Look at only this information. Looking at only investments information. Which company is better, do you think? Considering only the investments.
ಕಂಪ್ನಿ ಎಕ್ಸ್ ಮೋರ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್.
Okay, what does this Manupriya Tallur say? Considering only the investments, this slide information.
Yeah, Manupriya, ನೀವು ಮಾತಾಡಬಹುದು. Only thing is you have to unmute ಮಾಡಿ ನೀವು ಮಾತಾಡಬಹುದು. Or anybody has answer, please raise your hands. I will allow you to talk.
Yeah, there is an answer by someone that says because it gets a more profit to industry. Okay. How does it get more profit is not clear. Well, let me go back to the previous example. In the first example, I gave you the information about two companies and the profits earned by these two companies in one financial year, and company X has made 1,000 crores of net profits and company Y has made a net profit of 500. If you have to make a decision based on only this information, probably company X is better, because nobody wants to make an investment in a less profit making company. Given an opportunity, even I would like to invest in a company which has made more profits. Higher the profits, better the performance. That's the rule of investments. That's how we go. So if only this information is available. In the second example, the investment information is available. How much money has been invested in these two companies? And this information talks about the size of the company, how big the company is. Company X is bigger, then company Y is smaller in terms of capital, in terms of investments. So again, if I have to invest based on this information into these companies, probably I may again, you may again, we may again think of going for company X, because bigger the company, more stability, growth potential is high, kind of a thing. So we may go for company X. Now let me tell you, company X and Y in the first example when we showed the net profits, and company X and Y when we showed it in the second example as far as the investment is concerned, these are not different companies, these are the same companies. Company X with 1,000 crores of net profit is the same company having an investment of rupees 20,000, and similarly company Y having a net profits of rupees 500 is the same company which has an investment of rupees 5,000 crores. Hige helidaga, let us see them together. Let us see them together. Now in this slide, you can see the net profit is 1,000 crores for X and 500 crores for Y, and investment is rupees 20,000 crores in X and 5,000 crores in Y. When we compare these two, correlate these two, we get something called ROI. ROI stands for the return on investment, and that is equal to net profits by investments into 100. That comes to be 5% for company X and 10% for company Y. That is 1,000 rupees, 1,000 crores by 20,000 crores into 100 is 5%. For company Y, 500 by 5,000 into 100 is equal to 10%. Return on investment is for every 100 rupees of investment, how much profit do I get is what is return on investment. Now, correlating both net profits and investments of company X and company Y, question to the participants: which company has performed better, company X or company Y? If you are a potential investor, would you choose company X or would you choose company Y? Participants. Nivedita says Y, Umashri says Y. Okay. It is as simple as that. Like, if you invest 100 rupees in company X for 1 year, for that 100 rupees of investment, you would get 5 rupees return. If the same 100 rupees you invest in company Y, you would get 10 rupees of return. So obviously, higher the rate of return, better the performance is. So company Y would be more preferable as far as the investment is concerned, as far as the performance is concerned. So we may say company Y has performed better. Now go back to the first slide of example that I showed you. When we look at only this information, we may be deceived. It may be a little misleading to us if you are looking at only this information, because company X has earned more profits than company Y. So when we are ranking the companies based on the profits earned by the companies, probably we rate X as number 1 and Y as a last company in terms of earning the profitability. Similarly, when we looked at only the second slide of example, investments matra nodaga, again bigger company is more stable ಅನ್ನೋ ಒಂದು feeling ಬರುತ್ತೆ. company X is better ಅಂತ ಅವಾಗಲೂ ಹೇಳ್ತೀವಿ ನಾವು. But when we compare both of them, company X has earned a net profit of 1,000 crores for an investment of 20,000 crores, which means for 100 rupees of investment, company X has earned only 5 rupees. Similarly, for company Y, has earned a profit of 500 crores for an investment of 5,000 crores. That means to say, for an investment of 100 rupees, company Y would fetch you as high as 10% return. So with no doubt, we can say company Y has a better performance compared to X. Now, the point to be noted here is that this net profits, information ನಮಗೆ ಎಲ್ಲಿ ಸಿಗುತ್ತೆ? Information ನಮಗೆ profit and loss account ಅಲ್ಲಿ ಸಿಗುತ್ತೆ. When we look at profit and loss account of X, profit and loss account of Y, separate ಆಗಿ ನಾವು ಅದನ್ನು ನೋಡಿದಾಗ company X ಗೆ 1000 crores ಇದೆ, company Y ಗೆ 500 crores ಇದೆ. So we get this information in the P&L account. Investment details ಅನ್ನು ನಾವು ನೋಡೋದಾದ್ರೆ, investment details ಎಲ್ಲಿ ಸಿಗುತ್ತೆ? Balance sheet ಅಲ್ಲಿ ಸಿಗುತ್ತೆ. On the liability side of the balance sheet, we get this information about the investments. So profit and loss account ಮತ್ತೆ balance sheet ಎರಡು ಕೂಡ ಎಲ್ಲಿರುತ್ತೆ? So ಒಂದು ವೇಳೆ, listen to this case carefully. If I give you 100 profit and loss accounts in your hand, 100 profit and loss accounts andre P&L accounts of 100 companies last 1 year adu ಒಂದು 100 P&L account ನಾನು profit and loss account ನಿಮ್ಮ ಕೈಯಲ್ಲಿ ಕೊಟ್ಬಿಟ್ಟು rank these companies based on their performance ಅಂತ ಹೇಳಿದ್ರೆ ಏನ್ ಮಾಡ್ತೀರಾ ನೀವು? You normally tend to rank the companies based on the profits earned by them. Avaga, obviously a company which has earned the highest net profit would be ranked the number 1, and you go in the descending order of the net profits amount, and probably a company which has earned the least profit in the list would be ranked as the last one. Is it not? Similarly, if I give you balance sheets of some 100 companies in your hand, only balance sheets, nothing else, 100 balance sheets of companies I give you, and I ask you to rank these companies anta helidre, one of the criteria that you are going to use is the investments, because that talks about the size, and size of the company is very important. So avaglu enagodu, company X would be rated very high and company Y would be rated low because of the amount of investments andre financial. But reality alli enagide, now investments ಮತ್ತೆ net profit ಎರಡನ್ನು compare ಮಾಡಿ ನೋಡಿದಾಗ, though X ranks higher in terms of net profits when it is seen in isolation, when we see company X in terms of investments in isolation, in both the criteria X is better anta ಅನ್ಸುತ್ತೆ. Company Y in both the cases is not good anta ಅನ್ಸುತ್ತೆ. ಯಾವಾಗ ಅಂದ್ರೆ when we see net profits alone and investments alone. But when we compare net profit and investments together in relationship of net profits and investments, we come across with return on investment. Return on investment ನೋಡಿದಾಗ ನಮಗೆ ಅನ್ಸುತ್ತೆ, though profit is more in X, though investment is more in X is not performed better, because 1000 crores profit is for an investment of 20,000 crores. So for 100 rupees, how much is the profit? 5 rupees. But for company Y, though the profit is less, investment is less, the profit per investment of 100 rupees, the return is higher here, 10%. So we conclude that just looking at net profit or just looking at investment is not enough. We should think beyond. We should connect the profits and the investments with another tool called return on investment, and that gives us a better and comprehensive picture about the performance of the companies. ಈಗ net profit ಮತ್ತೆ investments ಎರಡು profit and loss account ಮತ್ತೆ balance sheet ಅಲ್ಲಿ ಇರುತ್ತೆ. Financial accounting does not tell you the complete story. That is what we need to understand. Profit and loss account and the balance sheet definitely provide you very good information about the profitability and the financial position, but as far as the performance of the company is concerned, the financial accounting in the form of P&L account and the balance sheet do not give you the complete story of the financial performance. So adakagi, to know the complete performance of the company, to know the complete story of the organization, we need to think one step beyond. We need to go one step beyond and link them, correlate them and use certain tools like return on investment. And this return on investment is one ratio. It is called a financial ratio. It is a financial ratio. And this kind of financial ratio is going to be part of management accounting. I hope you understand the importance of management accounting. You understand the importance of a ratio now. Now, return on investment is only one such ratio. There are going to be some 50 plus such financial ratios to look at the financial performance from different angles. Because now return on investment mukantara now one angle matra nodivi, that is from the profitability. Bari profits anna nodidivi, but profit is not everything. Profit is not everything. We need to look at the performance of the company from various angles. So that is what is done in management accounting. This is the introduction of management accounting. So ROI is a financial ratio, and ratio is a tool of financial analysis used in management accounting. I hope you clearly understand now the difference between financial accounting and management accounting. And you should also understand that management accounting is not possible without financial accounting. Financial accounting anna base anta tagondo the informations provided by financial accounting in the form of P&L account and balance sheet. The management accounting uses the performance analysis with various tools like ratios and other things. I hope this concept of management accounting ratio is clear to you. This example is also clear to you. If there is any doubt, we'll spend 1 minute and then proceed further.
Guys, you can type your doubts. Either type your doubts or raise your hands. So this is clear. You can go ahead.
All right. So I thought let me give this example to make you understand how management accounting is different from financial accounting, yet both are correlated. Because without the inputs by financial accounting, inputs like the net profit, inputs like the investments, and any information from the financial accounting, without this P&L account, balance sheet, the analysis and interpretation by management accounting is not possible. Hence, financial accounting and management accounting are interdependent in each other. At the same time, management accounting has a clear distinction from financial accounting. So that's about this example. Moving forward, there are various tools of management accounting. One such tool that we start with is ratio analysis. At the end of financial performance analysis, I'll give the list of all the tools once again in one separate slide. To start with, ratio analysis. Today we are going to discuss the ratio analysis as the tools of management accounting. So what is a ratio then? In the previous slide, I gave one example of a ratio here, ROI anta ಏನು ಬರೆದಿದ್ದೀವಿ. So return on investment is a ratio, financial ratio. Now what is this ratio then? Ratio is a financial tool that establishes the relationship between two financial variables. The two financial variables used in this particular ratio are, one is net profits, another one is the investment. So net profit is one financial variable, investments is another financial variable. So ratio is a tool that establishes the relationship between two financial variables and thereby helps us to analyze and interpret the performance of the organizations in a better way. That is what we mean by ratios. Now, there are so many ratios. They are categorized like this: liquidity ratios, solvency ratios, profitability, turnover ratios, coverage ratios, market test ratios. In each category, we get a couple of them, a couple of ratios to discuss. Let's look at one by one. Now, liquidity ratios. We must first understand what is liquidity, what is the meaning of liquidity, and what is the importance of this liquidity, why liquidity, then how much liquidity. Probably ನಾವು ಈ ಮೂರು ಪ್ರಶ್ನೆಗೆ ಉತ್ತರವನ್ನು ಸಮಂಜಸವಾಗಿ ಅರ್ಥ ಮಾಡಿಕೊಂಡ್ರೆ then we understand liquidity ratios thoroughly. What is liquidity? Question to the participants quickly without wasting much time here. What you understand by liquidity? Anybody from the participants can type the answer in the chat box. Cash in hand to meet liability is one answer we got in the chat box. Yes, absolutely. Thank you for that answer. Cash in hand to meet the liquidity. Yes, liquidity is a readily availability of cash. Going a little further, cash or cash equivalents, I would say. Another answer in the chat box. That says capacity to pay the liabilities of the company. Yes, of course. It is a capacity to pay the liabilities of the company with the help of short-term assets. That is what we mean by the liquidity. So here, cash in hand or cash at bank or short-term assets or current assets are the essence of calling it as a liquidity. So summing up all these answers, liquidity is the readily availability of cash in the organization or cash equivalents anta heltivi. Cash equivalents andre eno? Cash equivalents are other current assets. Yesterday we discussed on what are these current assets. Current assets are the short term assets which can be converted into cash in a span of less than 1 year, and the list of current assets also we saw yesterday as cash in hand, cash at a bank, sundry debtors, bills receivables, stock of goods or inventories. All these are the current assets. Then the amount, the quantum of current assets, quantum of cash, quantum of other cash equivalent assets, or which can be easily converted into cash. Andre ನಮ್ಮ ಹತ್ರ ಎಷ್ಟು readily available cash ಇದೆಯೋ ಅಥವಾ some other current assets which can easily be converted into cash when we need. So adanna ನಾವು liquidity ಅಂತ ಹೇಳ್ತೀವಿ. Sum total of cash and other current assets which are short term in nature. Adanna ನಾವು liquidity ಅಂತ ಹೇಳ್ತೀವಿ. Fine. Then why liquidity? What is the importance of liquidity? Why do we need liquidity? Yes, anybody? Quickly, like you typed earlier. Why is liquidity important? You can type and send it. Okay, capacity to pay the liabilities of the company. Okay, fine, you can type it later also. Why we need liability is because like we have current assets, we have current liabilities also in the firm. Yesterday we saw in the discussion of balance sheet, current liabilities include, current liabilities are the short-term liabilities. Short-term liabilities mean the liabilities which need to be repaid in a span of less than 1 year. Now current liabilities include the creditors, the bills payables, the bank overdraft, and the outstanding expenses. The answer given is capacity to pay the liabilities to the company for the fulfillment of the short-term liabilities. Yes, that's what I'm also saying. So the liquidity or the readily availability of cash or cash equivalents is required in order to pay the current liabilities in the form of creditors, bills payables, bank overdraft, outstanding expenses. So all these liabilities are termed to be the short-term liabilities, the current liabilities. These liabilities have to be repaid in a less than 1 year's span to meet out such expenses, to meet out such day-to-day requirements of the organization. We need to maintain a liquidity. So liquidity is very important. So what happens if there is no liquidity? If you ask a question like this, what happens if the liquidity is not there? I have a lot of current liabilities, but my current assets are not good. In that case, my current liabilities are more, my current assets are less, or my liquidity is poor, or I don't bother to maintain the liquidity position of the company. What's going to happen then? What is going to happen then is, if the liquidity is poor, your reputation is going to be affected. How? Suppose there are creditors. Let's take a very simple example to understand the importance of liquidity. There are creditors. Now let us understand the meaning of creditors. Creditors mean these are the suppliers of goods, commodities to us, right? They are called creditors because we have purchased some materials, we have purchased some goods, commodities from these people on a credit basis. So creditors are the people to whom we have to make the payment. So these are the creditors. Now, payment towards creditors becomes due. Now I need to pay to the creditors. If my liquidity position is there, cash balance is there, cash equivalent assets are there with me, easily I can make the payment towards the creditors. If my liquidity is not good, my liquidity position is not sound, then I'll not be able to make the payment towards the creditors immediately. Then I'll have to say sorry. I'll have to cut an excuse. I have to cut a sorry figure to the creditors. I say, I'm sorry, I cannot pay you. Now, is it a good sign to say sorry to your suppliers? There is a bank overdraft. Bank overdraft is a facility given by the banker to you to draw more balance than the actual balance in your account on a current account. In your current account, you draw more than 100 rupees, 120 rupees, 130 rupees, even though your balance is only 100. So the more than 100 rupees, what you draw from your bank account is known as the overdraft, overdrawn position in the health way. So overdraft facility is given by the banker based on your reputation, based on your relations with the banker, and which needs to be repaid again in a short term. Banker reminds you that your bank OD is due now, it is to be repaid, but you don't have a liquidity. Now, to pay creditors, you don't have a liquidity, you don't have a cash balance. To repay the bank overdraft, you don't have cash, you don't have a liquidity. Then what happens to your reputation in the market? If you go on missing the payment of obligations like this, your reputation gets affected. The creditors will think, the bankers will think, this person, this organization is not a trustworthy, cannot be relied upon. Their financial position is not good. Their liquidity is not sound. They are facing a liquidity crunch. Let me think again. Before, when I supply goods to this organization, no yochne creditors baratte. Let me think over once again. Before extending a loan, before giving a loan, before giving a credit facility, overdraft facility to this person, again, anta banker talel baratte. So that will affect your credibility in the market. That affects your reputation in the market. That affects your goodwill in the market, which is very, very important in the business, which is very important for the company. So why liquidity anta neevu kelidre? Liquidity is very important in order to uphold the credibility, reputation, or goodwill of the organization in the industry. So liquidity is extremely important for us. Now, the next question is, how much liquidity? Should it be high? Should it be low? Should it be moderate? So what do you think about it? Someone has said 2:1. It is too early to go to that ratio of 2:1, I feel. Let us go by understanding few more intricacies of liquidity ratios, and then we'll think of this ratio of 2:1. If I ask you, more liquidity, is there any harm? Somebody, if there's a more liquidity? Let me tell you before you answer, more liquidity means more of cash balance, more of cash equivalent assets in your hand, more of current assets in your hand, higher the liquidity, stronger the reputation is. Stronger the reputation is. In the sense, if you have very high liquidity, you are very strong in terms of repaying to the creditors, repaying towards the bank overdraft, repaying towards the outstanding expenses and whatnot. Okay, somebody has said yes to my understanding. So high liquidity means high reputation. Low liquidity means low reputation. But somebody has intervened and said 2:1 anta helidare. Let us understand that also by taking up tools to measure the liquidity. Now liquidity na henge quantify ಮಾಡಬೇಕು, more less ಅನ್ನೋದು it is subjective in nature. So we need to quantify that liquidity position of a company. To quantify, to measure the liquidity position of a company, we use these tools like current ratio, quick ratio, and NWC stands for net working capital. Let's look at that. Now current ratio nododadre, current ratio very simple formula is current ratio is equal to current assets upon current liabilities. Now munche nodida hage current assets include cash balance, bank balance, sundry debtors, bills, receivables and inventories. The current liabilities include the creditors, bills, payables, bank overdraft and the outstanding expenses. Current assets are what we have in our hand. Current liabilities are actually our obligations. We need to pay for these obligations. So idu formula enandre current assets upon current liabilities anta. Higa let us take some cases like this. If a company has a current ratio of 1:1, 1:1 andre eno, current asset is equal to 1, current liability is equal to 1, the ratio is going to be 1:1 andre ನಮ್ಮ ಹತ್ರ 100 rupees of current assets ಇದೆ, 100 rupees of current liabilities ಇದೆ. 2:1 ಅಂದ್ರೆ ಏನು? 2:1 means that I have 100 rupees of current liability for which I have 200 rupees of current assets. That is 2:1. Somebody said 2:1 is the good ratio to have anta. Before that, let me tell you 3:1 ಅಂದ್ರೆ ಏನು? 3:1 ಅಂದ್ರೆ 100 rupees is a current liability, 300 rupees is a current assets. So I can pay off 100 rupees of current liabilities. I am left with 200 rupees more of current assets in that case. The fourth one is 10:1 anta tagondre 100 rupees is a current liability, then 1000 rupees is a current assets, which means you 100 rupees current liabilities anna kotre, you are still left with 900 rupees of current assets in your hand. Liquidity position ratio henge current asset ಜಾಸ್ತಿ ಆಗ್ತಾ ಹೋಗುತ್ತೆ, your liquidity position goes on increasing. 1:1 ಅಲ್ಲಿ liquidity position is very poor, 2:1 ಅಲ್ಲಿ liquidity position has improved, 3:1 ಅಲ್ಲಿ it has still more improved, 10:1 ಅಲ್ಲಿ your liquidity position is extremely strong ಅಂತ ಹೇಳ್ಬೋದು. Now which ratio is advisable anta nanu question raise ಮಾಡಿದೀನಿ. Now the participants have to answer to this question, which ratio is the best and more importantly why. ಅದು ತುಂಬಾ ಇಂಪಾರ್ಟೆಂಟ್ ಆಗುತ್ತೆ ಇಲ್ಲಿ. Why ಅನ್ನೋದು ತುಂಬಾ ಇಂಪಾರ್ಟೆಂಟ್. Yes please. Over to you participants. Which ratio among these four is the best ratio in terms of liquidity, and why do you think that ratio is the best?
You can answer either by unmuting it or type it.
A couple of them have answered stating 2:1. More importantly, why do you think 2:1 is the best? Why not 3:1? Why not 10:1? And why not 1:1, of course? We need to discard the other three options with quite reasoning. Then we can agree upon 2:1 is the best. What is the reasoning for that? Two is to one, there's an answer. 2:1. If more we go for more ratio, then we have to pay more tax. Let me tell you, a higher current ratio does not call for paying the tax. So there is no connection between payment of tax and a higher current ratio. Okay, any other reason, any other answer? Quickly. Okay, there's another answer. 2:1 is better because if we have 100 is liability, then we have sufficient asset that is 200. My question to you is, why not 3:1? In case of 3:1, we have 300 of assets and 100 rupees of liabilities. Why not 10:1? If it is 10:1, for 100 rupees of current liability, you have 1,000 rupees of current assets. Why not 3:1, or why not 10:1 in that case? You can come online also, you can speak so that you can directly speak. That is also easier. If not, you can type the answer. But we need to be a little quicker because a lot of concepts, a lot of ratios to be discussed. Okay, 2:1, many of them said 2:1 is a good ratio. Probably that is because in the classroom, that is how it is taught. Most of the textbooks, when we look at the textbooks on financial analysis, management accounting, most of the textbooks say 2:1 is the ideal ratio. There is something like a standard ratio, ideal ratio kind of a thing. Unfortunately, many a times we don't think, go beyond 2:1. Why 2:1? Why not 3:1? Why not 10:1? Why not 25:1 kind of a thing? We don't think. Less than 2:1, 1:1. Let me explain all these four, probably more than these also. 1:1 ನೋಡೋದಾದ್ರೆ 1:1 ಅಂದ್ರೆ ಏನು? ನನ್ನ ಹತ್ರ 100 rupees current liability ಇದೆ. Equivalent to that, I have 100 rupees of current assets. So that means I am capable of meeting my current obligations. But the problem is, there are a lot of uncertainties in business. A lot of uncertainties, like unexpected exigencies will come. All of a sudden, some say lorry strike takes place, fuel price increases. Then lorry strike ಆದ ತಕ್ಷಣ ಏನಾಗುತ್ತೆ, lorry transportation close ಆಗ್ಬಿಡುತ್ತೆ. Transportation close ಆದಾಗ the required raw material is not available. ಆವಾಗ ಬ್ಲ್ಯಾಕ್ ಅಲ್ಲಿ ಮಾರಕ್ ಶುರು ಮಾಡ್ತಾರೆ, ಅಥವಾ raw material price increases all of a sudden. We need to pay a higher price. So ಹೀಗಾಗಿ a lot of exigencies. 1:1 is little risky ಅಂತ ನನ್ಗನ್ಸುತ್ತೆ. So 1:1 is like walking on a tight rope. Walking on a tight rope, you need to have a little cushion. You need to have some cushion to avoid the possibility of risk here. So going to 2:1. 2:1 is, as told by great authors in many textbooks, 2:1 is definitely a very good ratio, is because 100 rupees of current liabilities gain, we pay off 100 rupees of current assets, and we are left with 100 rupees of current assets more. So even if there is some emergency, even if there is some exigency, lorry strike ಆಗೋದಾಗ್ಲಿ, transportation problem ಆಗೋದಾಗ್ಲಿ, raw material price increase ಆಗೋದಾಗ್ಲಿ, ಅಂತ ಎಲ್ಲ uncertainties ಗೆ 2:1 would definitely give an answer to. There is some amount of cushion, there is some amount of leverage kept there. So 2:1 is definitely a comfortable ratio. But I don't believe that 2:1 is the best ratio, as many people believe. Okay, why anta kuda ಹೇಳ್ತೀನಿ ನಮಗೆ. Let's before that, let's go for 3:1. 3:1 ಅಂದ್ರೆ ಏನು? For 100 rupees of current liabilities, you have 300 rupees of current assets. From the point of view of liquidity, this is much better ratio than 2:1, no doubt in it. For 100 rupees of current liabilities, I pay 100 rupees of current assets. I'm still left with 200 rupees of current assets. ಯಾವುದೇ ತರ exigencies, emergencies, uncertainties ಬಂದ್ರೂ ಕೂಡ, I'm very strong. I'm very strong because I have 200 rupees more of current assets with me. Okay, let's go to, so 3:1 is definitely better than 2:1 in terms of liquidity, in terms of reputation, in terms of goodwill. Let's go to 10:1. 10:1 ನೋಡೋದಾದ್ರೆ, the meaning of 10:1 current ratio is, for every 100 rupees of current liabilities, the company has 1,000 rupees of current assets. Even if we pay 100 rupees of current liabilities, we are left with 900 rupees more of current assets. Now, compared to 2:1 and 3:1, 10:1 is much, much better in terms of liquidity, in terms of maintaining reputation, in terms of the goodwill of the company. So 10:1 is much better ratio compared to 2:1 and 3:1. Now, why do many people say 2:1 is the best? So for that, we need to understand what is the bad thing or what is the limitation of higher current ratio, taking examples of 3:1 and 10:1. We can think this way. The current assets come in the forms of, see, I have given example of 5. There are many more other current assets here: cash, bank, debtors, receivables, and inventory. These 5 assets. Now, when we look at these current assets, what is the return these current assets get us? ನಾವು 100 rupees ಅನ್ನ ಈ ಕರೆಂಟ್ ಅಸೆಟ್ಸ್ ಅಲ್ಲಿ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದಾಗ ಅದರಿಂದ ನಮ್ಗೆ ಎಷ್ಟು ರಿಟರ್ನ್ ಬರುತ್ತೆ ಅಂತ ನಾವು ಯೋಚನೆ ಮಾಡಬೇಕು. ಕ್ಯಾಶ್ ಅಲ್ಲಿ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದ್ರೆ ಏನು ರಿಟರ್ನ್ ಬರಲ್ಲ. ಬ್ಯಾಂಕ್ ಬ್ಯಾಲೆನ್ಸ್ ಅಲ್ಲಿ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದ್ರೆ how much return can we expect if we invest 100 rupees in bank balance? Let's say we invest 100 rupees for 1 year in the bank balance. How much return do you expect after 1 year? Approximately. You can just type the rate of return in percentage in the chat box. Question is, how much percentage of return do you expect if you invest 100 rupees on bank balance for 1 year span? Five percent, 6%, 7%, 8%, 10%. What is the rate of return do you expect? Somebody said 6%. Sir said 6%. Okay. So what makes you think 6%, sir?
No, that's what the banks
One
advertise.
is at 4%.
So if it is,
okay.
Yes.
Okay. Well. Somebody said 4%. I am sure if she can speak or otherwise, the account is 4%. If you go to nationalized bank, the rate of interest is less. If you go to private sector banks, interest rate is little higher. If you go to cooperative banks, the interest rate is still more higher. But the point that we need to understand as a students of accounts and finance, the bank balance here means it is a amount of money kept in current account. There are different types of accounts: savings bank account, current account, recurring deposit account or cumulative deposit account, fixed deposit account, FD account. So the balance, bank balance anta helidaga, necessarily it is the amount of cash deposited in the current account and only current account. It cannot be SB or FD or CD. Simple reason for that. The simple reason for that is when we are writing the accounts in the books of the organization, business anta helidaga, business can run its transaction only through the current accounts. We cannot do our business transactions using an SB account, which is illegal. If you are doing your business transactions using SB account in a bank, it is not legally done. And if the banker comes to know about that, the banker is going to close your bank account immediately. So it is essential that we assume, it's not assumption, it is a presumption rather. We presume that bank balance means it's a balance in current account of the bank. Now, how much return does a current account fetch you? What's the rate of return on the current account? You have kept 1 lakh rupees in your current account for 1 year. How much return in percentage do you expect? Quickly. No interest, that's right. No interest for current account balance. Your interest return on current account is absolutely zero Sometimes it works to be negative. Practically thinking, it works to be negative because there will be some charges on the current accounts. Interest is absolutely zero. So there is no interest given on the current account. So bank balance anta ನೀವು assume ಮಾಡಿದ್ರೆ return is zero. Cash is zero. Debtors, bills, receivables, the rate of return is going to be zero. If you invest in debtors and receivables, is going to be zero. Inventories and the stock of goods. If you invest some money in goods, you invest some money in inventories, goods, your return is going to be zero. So return on current assets is absolutely going to be zero. That is what is the important point you need to keep in your mind. When you invest more money in current assets in the form of these current assets, your profit is going to be zero. Your return is going to be zero. Your profitability is going to be hampered. So higher current ratio is good from the perspectives of the liquidity, reputation, and the goodwill, but at the same time, your profitability goes for a toss. Now, if I ask you, which is important between liquidity and profitability? If your liquidity is high, your profitability comes down. If your profitability is high, your liquidity comes down. Both are contradicting in each other. So which one is important to a business? Is it liquidity or is it profitability? Which is important? The answer is both are equally important to us. Reputation, goodwill of the organization is important. Equally, to run the business successfully, we need the profits also. Profitability is also equally important. So what happens when you go for a higher current ratio of 3:1 or 10:1, ಏನಾಗತ್ತಪ್ಪ ಅಂತಂದ್ರೆ you are unnecessarily investing more money into the current assets, and that is going to hamper your profitability for the business. And if the profitability is hampered, the growth of the business is hampered. Good from the perspectives of liquidity and the reputation of the business, it is to the profitability and the growth of the organization. So hagadre yavadu olledu? So shall we? Not exactly. I have a different take on the standard ratio. In fact, I don't believe in the standard ratio, although many textbooks say there's a standard ratio of 2:1. We cannot have 2:1 as a standard ratio for all the business organizations. Just to quote you an example, I discard outrightly the standard ratio of 2:1. The reason is this. Let me give you an example. Think that there is a very large organization, large in terms of its size, market capitalization, in terms of its turnover, assets, profitability, and many more financial variables. Something like a company like Reliance Industries Limited, Tata Groups. So big, large organization. This company versus there is a startup company, a company which has started recently, which does not have its track record or which does not have experience in selling goods, making profits, kind of thing. These are the two organizations, two business enterprises. Now, for an established company like Reliance, which already has its reputation in the business, which already has developed the relationships with the traders, suppliers, customers, then bankers, financial institutions, the government, regulatory bodies, they already have their own market share. They have developed the reputations, relationships, and all that. Versus another new startup, which is a nascent company, which is a new company, infant company, which is yet to grow. People don't know about this company. Bankers don't know about this company. It has not developed its relationship. It has not developed its market share yet. It's yet to grow. ಈ ಎರಡು ಕಂಪನಿಯನ್ನ ನಾವು ಎಕ್ಸಾಂಪಲ್ ಅಂತ ತಗೊಂಡ್ರೆ ರಿಲಯನ್ಸ್ ಇಂಡಸ್ಟ್ರೀಸ್ ಲಿಮಿಟೆಡ್ಗೆ what do you think? Do they require to maintain a higher current ratio? Higher current ratio andre you need to compromise on the profitability. Lower current ratio andre you are making more profitability anta artha. Reliance Industries Limited, Tata Motors, Aditya Birla Group, inta established company galige Is there a need? Is there a requirement to maintain a higher current ratio? No, absolutely no, because people know them well. Suppliers know them well. If Mukesh Ambani or Reliance Industries or
Hello.
hello, sir. There was a disturbance.
No problem, sir. No
So,
problem. Yes.
yes. Am I audible, sir?
Yes, yes, it is
So
clear.
continuing with this, so for a company, yeah, for a company like Reliance or Tata's or Birla's, so they can be okay. They can afford to maintain lower current ratio, and a newly startup company has to maintain a higher current ratio because they need to convince the business, they need to convince the industry people, they need to convince the traders, suppliers, bankers, and other stakeholders. So for established companies, lower current ratio is okay. For newly startup company, they need to maintain a higher current ratio. So where is the standard here? There's no standard. So the amount of current ratio to be maintained differs from one company to another company. Okay. Another example. Now, 10 years down the line, this new startup company, as I said in the example, is also developed now, is also established now in the 10 years. It has developed relationship with various stakeholders in the business. It has made sufficient profits. There's a track record to look back at. The balance sheet is quite sound now. Profitability is improved. Stability is come to this company. Now bankers know this company. The suppliers know this company. All the stakeholders know this company. Now this company, forget established companies like Reliance, Tata's, Birla's and all that. This company, if it is compared now versus 10 years back, there's a lot of improvement, development in this company. Now after 10 years, if this company wants to maintain a liquidity ratio like a current ratio, then same 3:1 or 4:1 or 5:1, which was required 10 years ago, is not required for this company to be maintained now. It can afford to maintain a lower current ratio now, because if this company says sorry to the bank manager, if it says bankers, so this month I'll not be able to repay the bank overdraft, the bank manager would say it's okay, because there is some rapport built between this company and the bank and other stakeholders. Hence, so for this company itself, 10 years back, it had to maintain a higher current ratio, but now it can maintain a lower current ratio. Like this, between two different companies, there are two requirements of the current ratio. Between the same company, some years ago and now, the requirement for the current ratio is changing. Earlier, probably they had to maintain 3:1 or 5:1, but now they're okay with 2:1. Probably in the next 10 years, 15 years down the line, this company is more popular in the business, in the industry. They may maintain a still lower current ratio, less than 2:1 could also be okay for them. So this is how, then how do we decide what is an ideal ratio? The current ratio, there is nothing like a standard ratio, blanket ratio anta iralla. For every company, there's a different current ratio. For every company, for every different period, different current ratios will be ideal for them. So depending upon where the business is, when the business was started, are you at the initial stage, are you developed, other ಮೇಲೆ ನೀವು current ratio na decide ಮಾಡಬೇಕಾಗುತ್ತೆ. At the initial stage of the business, higher current ratio is required, although you have to compromise on the profits in the initial stage. As and when you grow on, new business grow ಆಗ್ತಾ ಹೋದಂಗೆ current ratio level ಅನ್ನ ನೀವು ಕಡಿಮೆ ಮಾಡ್ತಾ ಬರಬೇಕಾಗುತ್ತೆ. But too low a current ratio is not good for any organization. This is how we need to look at the liquidity position of the company. Hope this is clear to all of you. If there are any questions, quickly in a minute we'll run through those questions and then I'll proceed with the next slide. Over to participants, please.
Any questions? Raise your hands, or you can unmute and talk. There are a few people are already in the call. Sir, you can continue.
Yes. So I hope you are clear with the current ratio and the liquidity. Current ratio is the main ratio. Just as a supplement to current ratio, there's a quick ratio also, little deviation from the current ratio. Quick ratio stands for quick assets by current liabilities. Quick assets nali now inventory stock of goods anna ಹೊರಗಡೆ ಇಟ್ರೆ that becomes quick assets. Desired ratio is minimum 1:1 and 1:1 because ಎಷ್ಟು current liabilities ಇದೆ ಅಷ್ಟು quick assets comparatively take a longer time to get converted into cash. One is desirable. Again, it may differ depending upon the little deviation in the net working capital. It is not a ratio as such, but then it identifies the relationship between the current assets and the current liabilities. So it's a difference between current assets and current liabilities. Excess of current assets or current liabilities ಅಂತನೂ ಹೇಳ್ಬೋದು. Desired level ಏನಪ್ಪಾ ಅಂದ್ರೆ it has to be positive, as simple as that. Negative idre we will not be able to pay off the current liabilities with the help of current assets. Andre current liabilities ಜಾಸ್ತಿ ಇರುತ್ತೆ ನೆಗೆಟಿವ್ ಆದ್ರೆ assets ಗಿಂತ. So that is not desirable. The desirable level is it should be so this is about the liquidity position of the company. Now we move on to the next more important aspect of solvency ratios. Now liquidity anna artha madkondvi. Now solvency ratio anna if yes could answer and from liquidity ಅಂತ ಹೇಳಿದ್ರೆ it will be easy for us further. Answer ಮಾಡಿಲ್ಲ ಅಂದ್ರೆ ನಾನು ಮಾಡ್ತೀನಿ. So the question is, do you understand?
Yes, sir. There was some disturbance.
So the question is, what do you understand by solvency, and how is solvency different from liquidity? Quickly, anyone? Okay, there is no answer. Okay, there is one coming up there. Say it meets long-term liability. That's absolutely right. Liquidity, that's right. Thank you. Liquidity means the ability of the company to meet its short-term liabilities in the form of creditors, bills payable, and all that we saw. Solvency position refers to the ability of the firm to meet out its long-term liability. Long-term liabilities come in the form of share capital, equity share capital, preference share capital, debentures, bonds, debt capital. Now, secured, unsecured loan, all that is part of the long-term liability. So solvency andre how strong a company is to meet its long-term liabilities. That is what we mean by solvency position. To measure the solvency position, we use some ratios like debt equity ratio. Debt stands for long-term debt, which includes debentures, bonds, and other long-term loans. Equity means the equity share capital and reserves and surplus normally. I just want to ask the participants, how comfortable are you with debt and equity? I don't know, because If I get to know you are comfortable with debt and equity concepts, I can proceed. Otherwise, we may have to spend little time on debt and equity, understanding what is debt, what is equity, characteristics, kind of a thing. Then we can proceed with understanding the debt equity ratio. To understand debt equity ratio, it is quite essential that you are comfortable with these concepts of debt and equity. I need some answers, please. Say comfortable or not comfortable with the concepts of debt and equity, all the intricacies of debt and equity. Kindly type comfortable or not comfortable. Okay. Yeah, looks like comfortable. Yes. Okay. Two of them have answered stating they are comfortable with debt and equity. So I presume all are comfortable. In case somebody has a doubt or a query as far as debt and equity is concerned, you can raise the question any point of time. I would be more than happy to answer to your questions. Now, debt comes in the form of debentures, bonds, and other long-term loans. Term loan ella debt alli barutte. Equity comes in the form of equity share capital, reserves and surplus. We have understood yesterday the meaning of reserve and meaning of a surplus. All together we call it as equity. Now, debt equity ratio is one such tool that measures the solvency position of the company. Now, upon equity andre equity share capital and reserves and surplus. Now, what is the desirable ratio anta ನಾವು ನೋಡಿದಾಗ high debt equity ratio is desirable or low debt equity ratio is desirable. Now, question to the participants again. What do you think? Debt equity ratio should be high or debt equity ratio should be low? I get two answers that state low. Two of them have answered stating low. Okay, I would also ask this question to both of you, Nivedita and Vani. What is wrong in having a high debt equity ratio? Okay, let me put it otherwise. Low debt equity ratio, probably they have said low is good because low debt equity ratio means low debt. Debt means sala. Sala kadme irbeku. Company will not get return on these investments. Now, it's like these are the sources of capital to you. The debt and equity are the sources of capital to you. The reason probably that you think why debt should be less is because if the debt is more, sala jasti adre, it will be a burden. It may lead for financial problems to the company. Company may be will not be in a position to pay off the interest in time. Company may not be in a position to pay off its repayment of capital. That may call for liquidation of the company, financial distress of the company. We have seen many companies like Kingfisher Airlines and the tagondre ನೀವು. It was a debt-ridden company. Debt-ridden company andre ತುಂಬಾ ಸಾಲ ತಗೊಂಡಿರ್ತಾರೆ ಅದನ್ನ repay ಮಾಡಕ ಆಗಲ್ಲ. So that could be one of the reasons what might happen if the debt equity ratio is very high. Let me also tell you the other side of the story. The other side of the story is that the good thing about having debt, that you must know, the good thing about having high debt amount is that debt is a cheaper source of capital compared to equity. Debt and equity eradu source. As a think from the company's perspective, think as a finance manager of a company. If you have to raise some money, let's say 100 crores of rupees you have to raise for the company in the form of capital, you have an option between debt and equity. Debt is cheaper source of capital compared to equity. ನೀವು ಡೆಟ್ ಈಕ್ವಿಟಿ ನಿಮಗೆ 15% ಕಾಸ್ಟ್ ಇದ್ರೆ ಕಾಸ್ಟ್ ಆಫ್ ಕ್ಯಾಪಿಟಲ್ ಅಂತ ಏನ್ ಹೇಳ್ತೀವಿ, ಕಾಸ್ಟ್ ಆಫ್ ಈಕ್ವಿಟಿ 15 ಇದ್ರೆ normally cost of debt would be somewhere between 11 and 12%. So you would be saving about 3% to 4% in terms of debt. Number one. Number two, other good thing of debt over equity is that the interest paid on debt, that is debentures or bonds or loans, is tax deductible, which means if you pay 100 rupees of interest to the investors, the company does not need to pay the tax on that interest. But equity mele dividend anna kottaga, dividend is taxable, interest is tax free. This way debt is attractive in many ways compared to equity, and that is the reason why companies go for debt. Nobody wants the financial distress to happen. Nobody wants the company to get into a bankruptcy mode. But the reason why companies go for debt capital is because of these two important reasons. The one is debt is a cheaper source of capital compared to preference, compared to equity, or compared to any other source of capital. Number one. Number two, debt, the interest is paid as a return on debt, and the interest on debt is tax deductible. This is another attractive thing. The company are paying around 30-35% tax, so that is exempted on the amount of interest paid by the company. This is attractive thing about the debt. That's why companies go for debt. So higher versions of corporate finance now yochne ಮಾಡ್ತಾ ಹೋದಾಗ, the objectives of any organization, objective of organization ನೋಡಿದಾಗ wealth maximization ಅನ್ನೋ ಒಂದು objective ಬರುತ್ತೆ. Kindly excuse me for 1 second. Just 1 second.
Yes, sir. Sure.
There was a little disturbance here, so I shut down the doors there. So the debt has this advantage. That's why most of the companies also think of going for debt. Now, high debt calls for risk of bankruptcy. That's why the ideal debt equity ratio is desired here. The ideal level of debt equity ratio has to be decided with the finance man. That is what we study here in the solvency ratios. Now, which is the desirable ratio? Low is definitely not good at all the times. High at all the times is not good again. Now, let me put it this way. Like current ratios, in the initial stage of the companies, when company has no track record, financial position is not that sound, profitability is not that high in the initial stage of the companies, a company cannot afford to take high risk. Company cannot afford to take high risk. Between debt and equity, debt is risky. Debt is risky because the interest on debentures, interest on debt is compulsorily to be paid, irrespective of profitability of the company. But equity nalla athara iralla. Equity dividend is not compulsory. Andre new profit ಆದರೆ equity dividend ಕೊಡಬೇಕಾಗುತ್ತೆ. Profit ಆಗಿಲ್ಲ ಅಂದ್ರೆ you don't have to pay the equity dividend. So between debt and equity, company perspectives ಅಲ್ಲಿ ನೋಡುವಾಗ debt is risky, equity is safe, stability is not high, financial position is not sound, track record is not there. It is advisable for the companies to maintain low debt equity ratio, more of equity, less of debt. More of equity, less of debt. I'm sure it will be costly affair for the company going for more of equity, because equity is costlier source of capital. Adru kuda you should go for more of equity, less of debt. So debt equity ratio should be low in the initial stage of the company. As and when you grow, as and when the profitability starts increasing, as and when the financial position improves for the company, this is a time for you to go for ಅದನ್ನ ಲಿವರೇಜ್ ಮಾಡ್ಕೋಬೇಕು. ನೀವು ಏನ್ ಲಿವರೇಜ್ ಮಾಡ್ಕೋಬೇಕಂದ್ರೆ, ಯು ಶುಡ್ ರೆಡ್ಯೂಸ್ ದ ಕಾಂಪೋನೆಂಟ್ ಆಫ್ ಇಕ್ವಿಟಿ, ಅಂಡ್ ಅಂದ್ರೆ ರೆಡ್ಯೂಸ್ ದ ಕಾಂಪೋನೆಂಟ್ ಸೆಲ್ ಮಾಡೋದಲ್ಲ. ವೆನ್ ದೇರ್ ಇಸ್ ಅ ರಿಕ್ವೈರ್ಮೆಂಟ್ ಫಾರ್ ರೇಸಿಂಗ್ ಅಡಿಷನಲ್ ಕ್ಯಾಪಿಟಲ್, ಬಿಸ್ನೆಸ್ ಎಕ್ಸ್ಪಾನ್ಷನ್ ಆಗ್ತಾ ಇರುತ್ತೆ, ಅಡಿಷನಲ್ ಕ್ಯಾಪಿಟಲ್ ಬೇಕಾದಾಗ, then you can have a proper mix of debt and equity. Then probably ಆವಾಗ ನೀವು equity component ಅನ್ನ ಸ್ವಲ್ಪ ಕಡಿಮೆ ಮಾಡಿ debt component ಅನ್ನ ಹೆಚ್ಚಿಗೆ ಮಾಡಿದ್ರೆ, you can save a lot of money in terms of cost of capital, because debt is cheaper than equity. ಹಾಗೆ ಎಷ್ಟು ಗ್ರೋ ಆಗ್ತಾ ಹೋಗ್ತಿರೋ ಡೆಟ್ ಕಾಂಪೋನೆಂಟ್ ಅನ್ನ ಹೆಚ್ಚಿಗೆ ಮಾಡ್ತಾ ಹೋಗ್ಬೇಕು, ಇಕ್ವಿಟಿ ಕಾಂಪೋನೆಂಟ್ ಅನ್ನ ಕಡಿಮೆ ಮಾಡ್ತಾ ಹೋಗ್ಬೇಕು. ಸೊ ಡೆಟ್ ಇಕ್ವಿಟಿ ರೇಷಿಯೋ ಯಾವುದು ಐಡಿಯಲ್ ಅಂದ್ರೆ there is no ideal ratio. It depends upon at which stage the company is. The financial stability of the company, profitability of the company will decide what should be the debt equity ratio. ನಿಮ್ದು ಪ್ರಾಫಿಟಬಿಲಿಟಿ ಟ್ರ್ಯಾಕ್ ರೆಕಾರ್ಡ್ ತುಂಬಾ ಚೆನ್ನಾಗಿದೆ, ನಾವು ಪ್ರಾಡಕ್ಟ್ ಲೈಫ್ ಸೈಕಲ್ ಅಥವಾ ಇಂಡಸ್ಟ್ರಿ ಲೈಫ್ ಸೈಕಲ್ ನೋಡಿದಾಗ ನಾವು ಯು ಹ್ಯಾವ್ ಗಾನ್ ಟು ಮ್ಯಾಚುರಿಟಿ ಸ್ಟೇಜ್, ಗ್ರೋತ್, ಇಂಟ್ರೊಡಕ್ಷನ್ ಗ್ರೋತ್ ಮತ್ತೆ ಮ್ಯಾಚುರಿಟಿ ಸ್ಯಾಚುರೇಷನ್ ಸ್ಟೇಜ್ ಇರುತ್ತಲ್ಲ. ಸೊ ಇಫ್ ಯು ಹ್ಯಾವ್ ರೀಚ್ ದ ಮ್ಯಾಚುರಿಟಿ ಸ್ಟೇಜ್ ಅಂದ್ರೆ ಯು ಕ್ಯಾನ್ ಟೇಕ್ ಎನಿ ಅಮೌಂಟ್ ಆಫ್ ಡೆಟ್, ಯು ಕ್ಯಾನ್ ಟೇಕ್ ಎನಿ ಅಮೌಂಟ್ ಆಫ್ ಡೆಟ್ ಫ್ರಮ್ ದ ಮಾರ್ಕೆಟ್. ಆದ್ರೂ ಕೂಡ line of cautious has to be followed here. That is, too much of a debt is not good for the organizations. Too much is too bad applies to debt also. Too much of debt is definitely not good for the organizations. There is something called a risk-taking capacity. Risk appetite anta karitivi financially. Risk appetite andre risk-taking capacity. Every organization has to assess its risk appetite. A risk appetite anna assess ಮಾಡಕ್ಕೆ credit rating agencies will help us. Credit rating agencies ನಮಗೆ ನಮ್ಮ risk assessment ಅನ್ನ ಮಾಡ್ತಾರೆ. Credit rating agencies are like Indian context ಅಲ್ಲಿ ನೋಡೋದಾದ್ರೆ CRISIL ಅಂತ ಇದೆ, CARE, ICRA ಅಂತ 3 famous organizations ಇದೆ credit rating agencies. In the international context ಅಲ್ಲಿ ನೋಡೋದಾದ್ರೆ S&P ಅಂತ ಇದೆ, ಸ್ಟ್ಯಾಂಡರ್ಡ್ ಕ್ರೆಡಿಟ್ ರೇಟಿಂಗ್ ಏಜೆನ್ಸಿ ಇದೆ. ಅದೇ ತರಹ ಫಿಚ್ ಅಂತ ಇನ್ನೊಂದಿದೆ. ಸೊ S&P, Moody's and Fitch in the international context. In the Indian context we have CRISIL, ICRA ಮತ್ತೆ CARE. ಸೊ ಅವರು ನಮಗೆ ರಿಸ್ಕ್ ಅಸೆಸ್ಮೆಂಟ್ ಮಾಡ್ಕೊಳ್ಳಕ್ಕೆ ಹೆಲ್ಪ್ ಮಾಡ್ತಾರೆ. Based on a risk appetite, we should have the debt equity ratio for the company. So that is about debt equity ratio, which is a very important tool to measure the solvency ratios. Other than solvency ratio, debt equity ratio, debt to total capital ratio kuda irutte. The formula is total debt upon total capital. This is a measure of the debt proportion to the total capital in the organizations. Debt equity ratio ನಲ್ಲಿ ಏನ್ ಮಾಡ್ತೀವಿ, ಡೆಟ್ ಮತ್ತೆ ಇಕ್ವಿಟಿ ಎರಡನ್ನೇ ಕಂಪೇರ್ ಮಾಡ್ತೀವಿ. ಇಲ್ಲಿ ಡೆಟ್ ಅನ್ನ ಟೋಟಲ್ ಕ್ಯಾಪಿಟಲ್ ಗೆ ಕಂಪೇರ್ ಮಾಡ್ತೀವಿ. ಸೊ ದಿಸ್ ಕ್ಯಾನ್ ಬಿ ಟೇಕನ್ ಎಸ್ ಅ percentage of debt in the total capital structure. Andre this is easier to understand actually. Andre for example ನಿಮ್ದು ಟೋಟಲ್ ಕ್ಯಾಪಿಟಲ್ ಬಂದು 100 rupees ಇದ್ದು ಅದರಲ್ಲಿ ಡೆಟ್ ಎಷ್ಟಿದೆ, 10 ಇದ್ರೆ 10%, 15 ಆದ್ರೆ 15%. ಆ ತರ percentage of debt to the total capital in the organization ಅನ್ನು ನೋಡ್ತೀವಿ. The analysis of this will be same as a debt equity ratio again. So it all depends upon the debt capacity of the firm ಅಂತ ಹೇಳ್ಬೋದು. This is about solvency ratios. I repeat once again, liquidity ratios help us understand the financial strength in the short term. Solvency helps us understand the financial strength of the company in the long term, the ability of the company to meet short term obligations and long term obligations. Short term obligations andre liquidity, long term obligations anna meet ಮಾಡೋ strength ಗೆ ನಾವು solvency ಅಂತ ಕರಿತೀವಿ. Together liquidity and solvency. If there are any questions, quickly 1 minute and then we move on to the next slide. Over to participants for the questions.
Guys, questions kelbodu. Those who are in the call, you can unmute and talk.
There's a question by Nivedita. It stands for the matra ide. Can you type it once again?
That is
incomplete
LT.
ಆಗಿದೆ ಅದು question ಅಲ್ಲಿ. It stands for ಅಷ್ಟೇ ಸಿಗ್ತಾ ಇದೆ.
LT.
Yeah. Oh, I'm sorry for. It is not a universal abbreviation actually. LT is long term. LT is long term. Okay. Long term debt. Okay. If there are no other questions, then we proceed. So we have understood the liquidity ratios and the solvency ratios. The third one is the profitability ratios. These ratios verify whether the profit is enough compared to various financial variables like investments, equity, assets, sales, working capital, fixed assets of the organizations, and many more. ನೋಡಿ, ಸುಮ್ಮನೆ ಒಂದು ಪಿಕ್ಚೋರಿಕಲ್ ಇದನ್ನ ರೆಪ್ರೆಸೆಂಟೇಷನ್ ತೋರಿಸಿದೀನಿ. ಪ್ರಾಫಿಟ್ ಈಸ್ ಕೆಪ್ಟ್ ಅಟ್ ದ ಸೆಂಟರ್ ಅಂಡ್ ಪ್ರಾಫಿಟ್ ಈಸ್ ಕಂಪೇರ್ಡ್ ವಿತ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ಸ್, ಈಕ್ವಿಟಿ, ಅಸೆಟ್ಸ್ ಅಂಡ್ ಸೇಲ್ಸ್. ಸೊ ಇಲ್ಲಿ ಪ್ರಾಫಿಟ್ ಈಸ್ ಶೋನ್ ಟು ಅಸ್ ಬೈ ದಿ ಪ್ರಾಫಿಟ್ ಅಂಡ್ ಲಾಸ್ ಅಕೌಂಟ್. ಪ್ರಾಫಿಟ್ ಅಂಡ್ ಲಾಸ್ ಅಕೌಂಟ್ ಅಲ್ಲಿ ನಮ್ಗೆ ಪ್ರಾಫಿಟ್ ಸಿಕ್ಬಿಟ್ಟಿರುತ್ತೆ ಆಲ್ರೆಡಿ. ಸೊ ಅದೇ ಸೇಮ್ ಪ್ರಾಫಿಟ್ ಅನ್ನ ನಾವು ಪ್ರಶ್ನೆ ಏನ್ ಮಾಡ್ತೀವಪ್ಪ ಅಂದ್ರೆ, P&L ಅಕೌಂಟ್ ಏನ್ ಹೇಳುತ್ತೆ, ಪ್ರಾಫಿಟ್ ಎಷ್ಟಿದೆ ಅಂತ ಹೇಳುತ್ತೆ. How much is the profit? Whether the profit is more or less ಅನ್ನೋದು ನಮಗೆ ಪ್ರಾಫಿಟ್ ಅಂಡ್ ಲಾಸ್ ಅಕೌಂಟ್ ಅಲ್ಲಿ ಗೊತ್ತಾಗುತ್ತೆ. ಬಟ್ ಮ್ಯಾನೇಜ್ಮೆಂಟ್ ಅಕೌಂಟಿಂಗ್ ಅಲ್ಲಿ ರೇಷಿಯೋಸ್ ಅಲ್ಲಿ ನಾವು ಏನ್ ಮಾಡ್ತೀವಪ್ಪ ಅಂದ್ರೆ, ವಿ ಡೋಂಟ್ ಲುಕ್ ಅಟ್ ದ ಅಮೌಂಟ್ ಆಫ್ ಪ್ರಾಫಿಟ್ ಬಿಕಾಸ್ ವಿ ಡೋಂಟ್ ಬಿಲೀವ್ ಇನ್ ದ ಅಮೌಂಟ್ ಆಫ್ ಪ್ರಾಫಿಟ್. Only amount of profit is not enough to understand. Only amount of profit is not going to answer to my analysis of financial performance. Now ನೋಡಿ, example ನಲ್ಲಿ company X had 1,000 crores of profit, but that more profit was not enough. So ಇಲ್ಲಿ ಪ್ರಶ್ನೆ ಏನ್ ಕೇಳ್ತೀವಿ ಅಂತಂದ್ರೆ, the amount of profit that is earned by the organization, is it enough? Is it good enough? Is it sufficient? Has it improved? ಆ ಪ್ರಶ್ನೆಯನ್ನ ನಾವು ಇಲ್ಲಿ ಮಾಡ್ತೀವಿ. ಸೊ ಇನ್ ದಟ್ ಕನೆಕ್ಷನ್, ಇನ್ ದಟ್ ಪರ್ಸ್ಪೆಕ್ಟಿವ್, ಆ ಪ್ರಾಫಿಟ್ ಅನ್ನ ಸೆಂಟ್ರಲ್ ಇಟ್ಕೊಂಡು ಆ ಪ್ರಾಫಿಟ್ ಅನ್ನ ನಾವು ಬೇರೆ ಬೇರೆ ಫೈನಾನ್ಷಿಯಲ್ ವೇರಿಯಬಲ್ ಗೆ ಕಂಪೇರ್ ಮಾಡಿ ನೋಡ್ತೀವಿ. ಹೇಗಪ್ಪ ಅಂತಂದ್ರೆ, ಪ್ರಾಫಿಟ್ ಇಸ್ ಕಂಪೇರ್ಡ್ ವಿತ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್. ಸೊ ಏನ್ ರೇಷಿಯೋ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡ್ತೀವಿ ಅಂತಂದ್ರೆ, ವಿ ಕ್ಯಾಲ್ಕುಲೇಟ್ ರಿಟರ್ನ್ ಆನ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್. ರಿಟರ್ನ್ ಆನ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಎಷ್ಟಿದೆ? 5% ಇದೆ, 10% ಇದೆ, 15% ಇದೆ. Is it good? Is it good enough? Is it sufficient? Has it improved? Has it worsened? ಈ ತರ ಪ್ರಶ್ನೆ ಮಾಡ್ತೀವಿ. ಅಗೇನ್ ಪ್ರಾಫಿಟ್ ಇಸ್ ಕಂಪೇರ್ಡ್ ವಿತ್ ಈಕ್ವಿಟಿ ಕ್ಯಾಪಿಟಲ್. ಅವಾಗ ಯಾವ ರೇಷಿಯೋ ಯೂಸ್ ಮಾಡ್ತೀವಿ? ಅವಾಗ ರಿಟರ್ನ್ ಆನ್ ಈಕ್ವಿಟಿ ಅಂತ ಹೇಳ್ತೀವಿ. ನೆಟ್ ಪ್ರಾಫಿಟ್ಸ್ ಅಥವಾ ಅರ್ನಿಂಗ್ಸ್ ಅವೈಲೇಬಲ್ ಟು ಈಕ್ವಿಟಿ ಶೇರ್ ಹೋಲ್ಡರ್ಸ್ ಅಪಾನ್ ದಿ ಈಕ್ವಿಟಿ ಶೇರ್ ಕ್ಯಾಪಿಟಲ್ ತಗೊಂತೀವಿ. ಸೊ ಅವಾಗ ನಮಗೆ ರಿಟರ್ನ್ ಆನ್ ಈಕ್ವಿಟಿ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡಿದಾಗ ಏನ್ ಗೊತ್ತಾಗುತ್ತೆ, ದ ಅಮೌಂಟ್ ಆಫ್ ಪ್ರಾಫಿಟ್ ಇಸ್ ಗುಡ್, ಬಟ್ ಈಸ್ ಇಟ್ ಗುಡ್ ಫಾರ್ ದ ಈಕ್ವಿಟಿ ಶೇರ್ ಹೋಲ್ಡರ್ಸ್ ಪರ್ಸ್ಪೆಕ್ಟಿವ್ಸ್ ಅಂತ ನೋಡ್ತೀವಿ. ಪ್ರಾಫಿಟ್ ಅನ್ನ ಅಸೆಟ್ ಕಂಪೇರ್ ಮಾಡಿದಾಗ ರಿಟರ್ನ್ ಆನ್ ಅಸೆಟ್ ಅಂತ ರೇಷಿಯೋ ಮಾಡ್ತೀವಿ. ಅಲ್ಲಿ ನೆಟ್ ಪ್ರಾಫಿಟ್ಸ್ ಡಿವೈಡೆಡ್ ಬೈ ಟೋಟಲ್ ಅಸೆಟ್ಸ್ ಮಾಡ್ತೀವಿ. ಸಮಟೈಮ್ಸ್ ನೆಟ್ ಪ್ರಾಫಿಟ್ಸ್ ಡಿವೈಡೆಡ್ ಬೈ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ಮಾಡ್ತೀವಿ. ಸೊ ರಿಟರ್ನ್ ಆನ್ ಅಸೆಟ್ಸ್ ಏನ್ ಹೇಳುತ್ತಪ್ಪ ಅಂದ್ರೆ, ದಿ ರೇಟ್ ಆಫ್ ಪ್ರಾಫಿಟ್ in relation with assets. So for example, it is 5% ಅಂತಿದ್ರೆ, ಒಂದು ಪ್ಯಾರಾಡಾಕ್ಸಿಕಲ್ ಡಿಫರೆನ್ಸಸ್ ಬರುತ್ತೆ ಕೆಲವು ಸಲ. ಏನಪ್ಪಾ ಅಂತಂದ್ರೆ, ರಿಟರ್ನ್ ಆನ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಇಸ್ 10%, ರಿಟರ್ನ್ ಆನ್ ಅಸೆಟ್ಸ್ ಇಸ್ 5%. ಸೇಮ್ ಪ್ರಾಫಿಟ್, ಒಂದೇ ವರ್ಷನೇ ನೋಡ್ತಾ ಇದೀವಿ ನಾವು, ಸೇಮ್ ಅಮೌಂಟ್ ಆಫ್ ಪ್ರಾಫಿಟ್, ಬಟ್ ವೆನ್ ಕಂಪೇರ್ಡ್ ಟು ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಅದು 10% ಬರುತ್ತೆ ರಿಟರ್ನ್ ಆನ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್. ವೆನ್ ಕಂಪೇರ್ಡ್ ಟು ಅಸೆಟ್ಸ್ through return on asset ಅಂತ ನೋಡಿದಾಗ ಅದು 5% ಬರುತ್ತೆ. So what is this paradox? Why this paradox? Return on investment is 10%, return on assets is 5%. ಈ ಡಿಫರೆನ್ಸ್ ಯಾಕಾಗುತ್ತೆ ಅಂತಂದ್ರೆ, that is why we need to do such ratios actually. ಯಾಕೆ ಆಗಿರುತ್ತೆ ಈ ತರ ಡಿಫರೆನ್ಸ್ ಅಂದ್ರೆ, ಅಸೆಟ್ಸ್ ಏನು ನಾವು ಇನ್ವೆಸ್ಟ್ ಮಾಡಿರ್ತೀವಲ್ಲ, ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ಇರ್ಬೋದು, ಟೋಟಲ್ ಅಸೆಟ್ಸ್ ಇರ್ಬೋದು. Assets are in the form of land, buildings, machinery, furniture, vehicles, motor vans, goodwill. Probably the utilization of the assets is not done to the extent of 100%. ಅಂದ್ರೆ ನಮ್ದೊಂದು 10 ಬಿಲ್ಡಿಂಗ್ಸ್ ಅನ್ನ ನಾವು 10 ಬಿಲ್ಡಿಂಗ್ಸ್ ಅಲ್ಲಿ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದೀವಿ, ಅಥವಾ ಒಂದೇ ಬಿಲ್ಡಿಂಗ್ ಅಲ್ಲಿ 10 ರೂಮ್ಸ್ ಇದೆ, 10 ರೂಮ್ಸ್ ಇದೆ.
Yeah, I think we have lost Mantesh sir. We will wait for a couple of minutes before he joins back. Yes, sir. Hello.
Hello, sir. Reason is underutilization of some of the assets. That's why the return on assets is 5%, but return on investment is 10%. Similarly, return on sales bandaga, it may be having a different percentage. So, on the hypothetical example, return on investment is 10%, return on equity is 15%, return on assets is 5%, return on sales is 7%. These are differing.
Hello.
Hello, sir.
Yes, sir. Yes, sir.
There is it's raining here, sir, in Belgavi. Probably because of there is some disturbance.
Okay, sir. Okay. No problem.
Yeah, I'll go a little faster now.
Yes, sir.
So return on investment is different, return on equity is different, return on assets is different, return on sales is different. So ಈ ತರ ಆಗೋ ಸಾಧ್ಯತೆಗಳಿರುತ್ತೆ. So that is why we need to do this ratio analysis for the profitability ratios ಮಾಡೋದ್ರಿಂದ ಯಾಕೆ ಈ ತರ ಡಿಫರೆನ್ಸ್ ಇದೆ, ಅಂತ ನೋಡಿದಾಗ ಅಂಡರ್ ಯುಟಿಲೈಸೇಷನ್ ಆಫ್ ಅಸೆಟ್ಸ್ or sales force not being so efficient or equity expectations are less or high. So ಇದೆಲ್ಲ ಗೊತ್ತಾಗುತ್ತೆ. So through that we come to know which section of the company is performing well and which section is not doing well. So this is about profitability ratios. There are various profitability ratios that we study under this category: gross profit margin, net profit margin, return on investment, return on equity, return on assets, return on sales, return on working capital. List goes on and on. Here the profit in terms of earning the profits. This is about profitability ratios. Quite simple to understand. Higher the profitability ratio, better it is. So I'll quickly run through the other types of ratios also. Turnover ratios and the next category. It's a tool to measure the efficiency to convert inventories, and that is about inventory ratios. Three types of ratios are there: inventory turnover, debtors turnover, and creditors turnover. ಒಂದೊಂದೇ ನೋಡ್ತಾ ಹೋಗೋಣ. ಇನ್ವೆಂಟರಿ ಟರ್ನ್ ಓವರ್ ರೇಷಿಯೋ. ಇನ್ವೆಂಟರಿ ಅಂದ್ರೆ goods are the articles which are meant for reselling purpose. How fast inventory is converted into sales ಅನ್ನೋದನ್ನ ಇನ್ವೆಂಟರಿ ಟರ್ನ್ ಓವರ್ ರೇಷಿಯೋ ಹೇಳುತ್ತೆ. ಇನ್ವೆಂಟರಿ ಎಷ್ಟು ಲೇಟ್ ಆಗಿ ನಾವು ಸೇಲ್ಸ್ ಕನ್ವರ್ಟ್ ಮಾಡ್ತೀವೋ ಅಷ್ಟು ನಮಗೆ ಕಾಸ್ಟ್ ಜಾಸ್ತಿ ಆಗುತ್ತೆ. ಬಿಕಾಸ್ ಇನ್ವೆಂಟರಿಯನ್ನ ನಾವು ಇಟ್ಕೊಂಡ್ರೆ ಇಟ್ ಕ್ಯಾರೀಸ್ ಅ ಕಾಸ್ಟ್, ಕ್ಯಾರಿಂಗ್ ಕಾಸ್ಟ್ ಇರುತ್ತೆ. ಗೋಡೌನ್ ರೆಂಟ್ ಕೊಡಬೇಕು, ಶೋರೂಮ್ ರೆಂಟ್ ಕೊಡಬೇಕು, ಅದೆಲ್ಲ ಇರುತ್ತೆ. ಸೊ the effort should be to convert inventory into sales as soon as possible. So inventory turnover ratio ಅನ್ನ ಹೇಗೆ ಮೆಜರ್ ಮಾಡಿದ್ರೆ ಕಾಸ್ಟ್ ಆಫ್ ಗೂಡ್ಸ್ ಸೋಲ್ಡ್ ಅಥವಾ ಸೇಲ್ಸ್ ಡಿವೈಡೆಡ್ ಬೈ average inventory ಇಂದ ತಗೋತೀವಿ. So more than the formula, let us understand how to analyze this ratio. ITOR ಅಂದ್ರೆ inventory turnover ratio ಅಂತ, ಇಲ್ಲಿ abbreviation. Inventory turnover ratio of an organization is as follows: 10 times, 15 times, 20 times and 30 times. Which ratio is the best among the above ಅಂತ ಕೇಳಿದೀನಿ. ಟೈಮ್ ಜಾಸ್ತಿ ಇಲ್ಲದೆ ಇರೋದ್ರಿಂದ ನಾನೇ ಆನ್ಸರ್ ಮಾಡ್ಬಿಡ್ತೀನಿ. Higher the inventory turnover ratio, better is the performance. So 30 times is the best, 10 times is the worst ಅಂತ ಹೇಳ್ಬೋದು. Higher the inventory turnover ratio, it is best. ಅದರ ಮೀನಿಂಗ್ ಏನಪ್ಪ? 10 times ಅಂದ್ರೆ ಏನು? On an average, in a span of 1 year, company is able to convert its inventory into sales for 10 times ಅಂತ. ಅದೇ 30 times ಇದ್ದಾಗ on an average a company is able to convert its goods into sales for 30 times ಅಂತ. So higher the inventory turnover ratio, better the performance it is. ಇನ್ವೆಂಟರಿ ಟರ್ನೋವರ್ ರೇಷಿಯೋನ ಅರ್ಥ ಮಾಡ್ಕೊಳ್ಳೋದಕ್ಕೆ there is a reciprocal ratio of inventory turnover ratio that is known as inventory holding period ಅಂತ IHP ಅಂತ ಕರಿತೀವಿ. Inventory holding period is a reciprocal ratio of inventory turnover ratio. This explains you for how many days the inventory is held in the store, in the godown, within the company ಅನ್ನೋದನ್ನ ಹೇಳುತ್ತೆ. IHP stands for inventory holding period. So that is equal to 360 days ಅಂತ ತಗೊಂಡಿದ್ದೀನಿ. Normally for easy calculations, it is rounded off 365 days. Number of days in a year ado, for number of weeks anna tagobodu, months anna kuda tagobodu. So number of days 360 anta assume madidvi, divided by inventory turnover ratio. On the example now, inventory turnover ratio previous slide alli 10 ಮತ್ತೆ 30 ಅನ್ನ ನಾನು ಕಂಪ್ಯಾರಿಸನ್ ಅಂತ ತಗೊಂಡಿದ್ದೀನಿ. 10 inventory turnover ratio ಇದ್ದಾಗ 360 days upon inventory turnover ratio 36 days ಆಗುತ್ತೆ. ಇದರ ಅರ್ಥ ಏನಪ್ಪಾ ಅಂದ್ರೆ, on an average the company is holding its inventory in the company for inventory turnover ratio ಇದ್ದಾಗ ಏನಾಗುತ್ತೆ 360 equals to 12 days ಆಗುತ್ತೆ. ಇದರ ಅರ್ಥ ಏನಂದ್ರೆ, the company is holding its inventory, holding its stock in the company in the godown for a period of 12 days on an average ಅಂತ. Which is better? Holding inventory for 36 days is better, or holding inventory 12 days is better? Holding inventory for a lesser number of days is always better. That is 12 days is better than 36 days. 12 days ಯಾವಾಗ ಬಂತು? Inventory turnover ratio 30 ಇದ್ದಾಗ ಬಂತು. 36 days 10 inventory turnover ratio ಇದ್ದಾಗ. So higher the inventory turnover ratio, lower will be the IHP, and that would be better, and vice versa. So inventory turnover ratio measures the efficiency of the sales department. Sales department, sales force ಏನಿರುತ್ತೆ organization ಅಲ್ಲಿ, how efficiently they are working ಅನ್ನೋದನ್ನ measure ಮಾಡುತ್ತೆ. It is inventory turnover ratio. Another turnover ratio is the debtors turnover ratio. Debtors ಅಂದ್ರೆ the customers who have purchased goods from us on a credit basis. ನಮ್ಮಿಂದ ಸಾಲ ತಗೊಂಡವರು, ಅವರು ನಮಗೆ ದುಡ್ಡು ವಾಪಸ್ ಕೊಡಬೇಕು. Debtors turnover ratio ಏನ್ ಹೇಳುತ್ತಂದ್ರೆ, how fast the debtors are converted into cash. Goods ಅನ್ನ ಸೇಲ್ ಮಾಡ್ತೀವಿ. ಸೇಲ್ ಮಾಡಿದಾಗ there are two types of sales. One is cash sales, another one is credit sales. ಆ credit sales ಅನ್ನ ನಾವು debtors ಅಂತ ಕರಿತೀವಿ. When all the debtors are combined, we call them as sundry debtors ಅಂತ ಕರಿತೀವಿ. ಆ debtors ಏನಿರ್ತಾರೆ, ಅವರಿಂದ ನಾವು ಕ್ಯಾಶ್ ಅನ್ನ ಕಲೆಕ್ಟ್ ಮಾಡಬೇಕು. ಡೆಟರ್ಸ್ ಇಂದ ಕ್ಯಾಶ್ ಕಲೆಕ್ಟ್ ಮಾಡೋದನ್ನ ಡೆಟರ್ಸ್ ಅನ್ನ ಕ್ಯಾಶ್ ಗೆ ಕನ್ವರ್ಟ್ ಮಾಡೋದಂತ ಹೇಳ್ತೀವಿ. ಸೊ ಟರ್ನ್ ಓವರ್ ರೇಷಿಯೋ ಏನ್ ಮೆಜರ್ ಮಾಡತ್ತಂದ್ರೆ, ಹೌ ಫಾಸ್ಟ್ ದ ಡೆಟರ್ಸ್ ಆರ್ ಕನ್ವರ್ಟೆಡ್ ಇನ್ ಟು ಕ್ಯಾಶ್. ಸೊ ಡೆಟರ್ಸ್ ಇಂದ ನಾವು ಎಷ್ಟು ಬೇಗ ಆಗುತ್ತೆ ಅಷ್ಟು ಬೇಗ ಕ್ಯಾಶ್ ಅನ್ನ ಕಲೆಕ್ಟ್ ಮಾಡಬೇಕು. ಸೊ ಡೆಟರ್ಸ್ ಟರ್ನ್ ಓವರ್ ರೇಷಿಯೋ ಎಷ್ಟು ಹೆಚ್ಚಿರುತ್ತೋ ಅಷ್ಟು ನಮ್ಗೆ ಒಳ್ಳೆಯದು. ಸೊ ಡೆಟರ್ಸ್ DTOR ಅಂದ್ರೆ ಡೆಟರ್ಸ್ ಟರ್ನ್ ಓವರ್ ರೇಷಿಯೋ ಈಕ್ವಲ್ಸ್ ಟು ಕ್ರೆಡಿಟ್ ಸೇಲ್ಸ್. ಕ್ರೆಡಿಟ್ ಸೇಲ್ಸ್ ಡೆಟರ್ಸ್ ಆಗುತ್ತೆ ಡಿವೈಡೆಡ್ ಬೈ ಆವರೇಜ್ ಡೆಟರ್ಸ್ ಅಂತ. ಎಕ್ಸಾಂಪಲ್ ನೋಡುವಾಗ 10 times 20, 30, 40 which is the best for the company ಅಂತ ಹೇಳಿದ್ರೆ, higher the debtors turnover ratio, better it is for the company. ಎಷ್ಟು ಜಾಸ್ತಿ ಇರುತ್ತೆ ಅಷ್ಟು ನಮಗೆ ಒಳ್ಳೆಯದಾಗುತ್ತೆ. The reciprocal ratio of debtors turnover is average collection period ಅಂತ ಹೇಳ್ತೀವಿ. It is a reciprocal ratio. It measures on an average for how many days or weeks or months the organization requires to collect money from its debtors or from its customers. ACP stands for average collection period. That is equal to number of days or weeks or year in a year. Small correction here. Days or weeks in a year divided by debtors turnover ratio. Now, one the example ತಗೊಳ್ಳೋದಾದ್ರೆ 360 days in a year upon 10 ಅಂತ ತಗೊಂಡ್ರೆ ಇಲ್ಲಿ 36 days ಆಗುತ್ತೆ. 36 days ಆಗುತ್ತೆ. ಅದೇ 360 days in a year upon 20 debtors turnover ratio ಇದ್ದಾಗ ಏನಾಗುತ್ತೆ, the 360 divided by 20 ಆದ್ರೆ 18 days ಆಗುತ್ತೆ. ಇದರ ಅರ್ಥ, in the first example a company requires 36 days to collect cash from the debtors. In the second example, company requires only 18 days to collect cash from the customers or the debtors. So 18 days is better compared to 36 days. So the conclusion of this ratio is that higher the debtors turnover ratio, better is the performance of the company. It measures the efficiency of the recovery department of the organization. So Inventory turnover ratio measures the efficiency of sales department, and debtors turnover ratio measures the efficiency of the recovery department. I hope ಇಲ್ಲಿ ACP example ಇತ್ತು, ನಾನು ಅಲ್ಲೇ ನಿಮಗೆ ತೋರಿಸಿದೆ. 10, 20, 30, 40 ಇದ್ದಾಗ average collection period, ACP's average collection period ಹೇಗೆ ಚೇಂಜ್ ಆಗ್ತಾ ಹೋಗುತ್ತೆ ನೋಡಿ. debtors turnover ratio ಹೆಚ್ಚಾಗ್ತಾ ಹೋದಂಗೆ average collection period ಕಡಿಮೆ ಆಗ್ತಾ ಹೋಗುತ್ತೆ. ನೀವು ಎಷ್ಟು ಬೇಗ ದುಡ್ಡನ್ನ ಡೆಟರ್ಸ್ ಕಡೆಯಿಂದ ಕಲೆಕ್ಟ್ ಮಾಡ್ತಿರೋ ಅಷ್ಟು ನೀವು ಅದನ್ನ ಬೇರೆ ಕೆಲಸಕ್ಕಾಗ ಉಪಯೋಗಿಸಬಹುದು. ಇಟ್ ಇಸ್ ಗುಡ್ ಫಾರ್ ಯು. ಹೈಯರ್ ದ ಡೆಟರ್ಸ್ ಟರ್ನೋವರ್ ರೇಷಿಯೋ, lower will be the ECP, and that signifies better performance in terms of managing the debtors or collecting cash from the debtors. On the contrary, lower the debtors turnover ratio, higher will be ECP, and that signifies poor performance in terms of managing the debtors ಅಥವಾ collecting the debtors ಅಂತ ಹೇಳ್ಬೋದು. I hope the turnover ratios are clear to you. The next one is coverage ratios anta. Coverage ratio, these ratios are used to satisfy the external stakeholders like bankers, financiers, money lenders anta ಹೇಳ್ತೀವಿ. More than we are interested, the company is interested, it is to satisfy the external stakeholders, bankers. ಸುಮಾರು ಸಲ ನಾವು ಬ್ಯಾಂಕ್ ಅಲ್ಲಿ ಸಾಲ ತಗೋಬೇಕಾದ್ರೆ ಮೋರ್ ದೆನ್ ರಿಟರ್ನ್ ಆನ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್, ಮೋರ್ ದೆನ್ ನೆಟ್ ಪ್ರಾಫಿಟ್ ಮಾರ್ಜಿನ್, ದೇ ಲುಕ್ ಫಾರ್ ಕವರೇಜ್ ರೇಷಿಯೋಸ್. ಯಾಕಂದ್ರೆ ಅವ್ರ ಸ್ಟೇಕ್ ಹೋಲ್ಡಿಂಗ್, ಅವ್ರ ಇಂಟ್ರೆಸ್ಟ್ ಇಲ್ಲಿ ಜಾಸ್ತಿ ಇರುತ್ತೆ. ಹೈಯರ್ ದ ಕವರೇಜ್ ರೇಷಿಯೋಸ್, ಹ್ಯಾಪಿಯರ್ ದ ಸ್ಟೇಕ್ ಹೋಲ್ಡರ್ಸ್ ಆರ್, ಗುಡ್ ಪರ್ಫಾರ್ಮೆನ್ಸ್ ದ ಕಂಪನಿ ಹ್ಯಾಸ್ ಅಂತ. ಎರಡು ಕವರೇಜ್ ರೇಷಿಯೋಸ್ ಅನ್ನ ನಾವು ಸ್ಟಡಿ ಮಾಡ್ತೀವಿ. ಒಂದು ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ, ಎರಡನೇದು DSCR ಅಂತ. ಸೊ ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ ಅಂದ್ರೆ ಏನು? By how many times the interest is covered by earnings ಅಥವಾ profits ಅಥವಾ EBIT ಅಂತ. EBIT stands for earnings before interest and tax. ICR ಅಂದ್ರೆ interest coverage ratio is equal to EBIT, that is earnings before interest and tax, ಅಥವಾ ಅದನ್ನ ನೀವು ಸಿಂಪಲ್ ಆಗಿ ಪ್ರಾಫಿಟ್ಸ್ ಅಂತ ಕೂಡ ಹೇಳ್ಬೋದು. EBIT is nothing but operating profits. ಸೊ ಫಾರ್ಮುಲಾದಲ್ಲಿ ನೋಡೋದಾದ್ರೆ ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ ಇಸ್ ಈಕ್ವಲ್ ಟು EBIT ಅಥವಾ ಪ್ರಾಫಿಟ್ಸ್ ಡಿವೈಡೆಡ್ ಬೈ ಇಂಟ್ರೆಸ್ಟ್ ಪೇಮೆಂಟ್ಸ್. ಫಾರ್ ಎಕ್ಸಾಂಪಲ್, ದ ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ ಆಫ್ 20 times ಇದ್ರೆ ಇದ್ರ ಅರ್ಥ ಏನಪ್ಪಾ ಅಂತಂದ್ರೆ, ಬ್ಯಾಂಕರ್ ಪರ್ಸ್ಪೆಕ್ಟಿವ್ ಅಲ್ಲಿ ಯೋಚನೆ ಮಾಡಿ ನೋಡಿ. ₹1 ಇಂಟ್ರೆಸ್ಟ್ ಪೇಮೆಂಟ್ಗೆ ₹20 ಪ್ರಾಫಿಟ್ ಕಂಪನಿ ಹತ್ರ ಇದೆ ಅಂತ ಅದರ ಅರ್ಥ. ಅದೇ 10 times ಆದಾಗ, ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ 10 times ಆದಾಗ ಏನಾಗುತ್ತೆ, ₹1 ನೆಟ್ ಇಂಟ್ರೆಸ್ಟ್ ನನಗ್ ಕೊಡ್ಬೇಕಲ್ಲ ಕಂಪನಿಯವರು, ₹1 ಇಂಟ್ರೆಸ್ಟ್ಗೆ ಕಂಪನಿ ಹತ್ರ ₹10 ಪ್ರಾಫಿಟ್ ಇದೆ. ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ 1 ಆದಾಗ ಏನಾಗುತ್ತೆ, ₹1 ಪ್ರಾಫಿಟ್ಗೆ ₹1 ಇಂಟ್ರೆಸ್ಟ್ ಕೊಡ್ಬೇಕು. ಅಂದ್ರೆ ಇಂಟ್ರೆಸ್ಟ್ ಕೊಟ್ರೆ ಅವ್ರ ಹತ್ರ ಏನ್ ಬೇರೆ ದುಡ್ಡೇ ಉಳಿಯಲ್ಲ ಪ್ರಾಫಿಟ್ ಅಲ್ಲಿ ಅಂತ. ಹೈಯರ್ ದಿ ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ, better the performance is. And as I told earlier, e ratio na mostly we calculate to satisfy the bankers and other financial institutions. More so it is calculated when we want to raise some funds from the banks and other financial institutions. The another ratio is DSCR anta, debt service coverage ratio anta ಹೇಳ್ತೀವಿ. DSCR stands for debt service coverage ratio. This takes into account the repayment of this ratio ನಲ್ಲಿ ನಮ್ಮ ಪ್ರಾಫಿಟ್ ಟು ಇಂಟ್ರೆಸ್ಟ್ ಕಂಪೇರ್ ಮಾಡಿದ್ರೆ ಎಷ್ಟು ಹೆಚ್ಚಿದೆ ಅನ್ನೋದನ್ನ ನೋಡುತ್ತೆ. ಬಟ್ ಬರೀ ನಾವು ಇಂಟ್ರೆಸ್ಟ್ ನೋಡಿದ್ರೆ ಸಾಕಾಗಲ್ಲ, ಕೆಲವು ಟೈಮ್ ನಾವು ಇಂಟ್ರೆಸ್ಟ್ ಜೊತೆಗೆ ಪ್ರಿನ್ಸಿಪಲ್ ರೀಪೇಮೆಂಟ್ ಮಾಡಬೇಕಾಗುತ್ತೆ. ಹಾಗಾಗಿ ನಮ್ಮ ಹತ್ರ ಇರುವಂತ ಪ್ರಾಫಿಟ್ಸ್ ಇಂಟ್ರೆಸ್ಟ್ ಮತ್ತೆ ಪ್ರಿನ್ಸಿಪಲ್ ಕೊಡಕ್ಕೆ ಎಷ್ಟು ಶಕ್ಯ ಇದೆ ಅನ್ನೋದನ್ನ ನೋಡೋಕೆ ನಾವು DSCR ಅನ್ನ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡ್ತೀವಿ. Bullet point 2 ನೋಡೋದಾದ್ರೆ, applicable only for the year when the loan is matured and the repayment is done. ಇದು ಪ್ರತಿ ವರ್ಷ ನಾವು DSCR ಅನ್ನ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡೋದು ಅವಶ್ಯಕತೆ ಇರಲ್ಲ, ಬಿಕಾಸ್ ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ ಅನ್ನ ನಾವು ಪ್ರತಿ ವರ್ಷ ಮಾಡ್ಬೇಕಾಗತ್ತೆ. ಯಾಕಂದ್ರೆ ಇಂಟ್ರೆಸ್ಟ್ ಅನ್ನ ಪ್ರತಿ ವರ್ಷ ಕೊಡ್ಬೇಕಾಗತ್ತೆ. ಆದ್ರೆ DSCR ಅನ್ನ ಯಾವಾಗ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡ್ಬೇಕಂದ್ರೆ, ಯಾವಾಗ ಲೋನ್ ರೀಪೇಮೆಂಟ್ ಬರುತ್ತೆ ಅವಾಗ ಮಾತ್ರ ನಾವು ಇದನ್ನ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡ್ಬೇಕು. For example, we have taken a loan from a bank for a period of 10 years ಅಂತ ಒಂದು ಎಕ್ಸಾಂಪಲ್ ತಗೊಂಡ್ರೆ, for the first 9 years ಗೆ ನಾವು ಇಂಟ್ರೆಸ್ಟ್ ಮಾತ್ರ ಪೇಮೆಂಟ್ ಮಾಡ್ತಾ ಇರ್ತೀವಿ. So for the first 9 years we have to calculate only interest coverage ratio. 10th year ಬಂದಾಗ we pay interest and principal amount also. ಆವಾಗ ನಾವು ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ ಜೊತೆಗೆ DSCR ಕೂಡ ನಾವು ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡಬೇಕಾಗುತ್ತೆ. So this has to be kept in mind. Third bullet point, it is not applicable if the loan is repaid using EMI mode. EMI ಅಂದ್ರೆ ಈಕ್ವೇಟೆಡ್ ಮಂತ್ಲಿ ಇನ್ಸ್ಟಾಲ್ಮೆಂಟ್. ಈಕ್ವೇಟೆಡ್ ಮಂತ್ಲಿ ಇನ್ಸ್ಟಾಲ್ಮೆಂಟ್ ಮೋಡ್ ಅನ್ನ ಯೂಸ್ ಮಾಡಿ, ಈಗ ಮೋಸ್ಟ್ ಆಫ್ ದ ಲೋನ್ಸ್ ವಿ ಯೂಸ್ EMI, ಬಟ್ ಟರ್ಮ್ ಲೋನ್ಸ್, ಇಂಡಸ್ಟ್ರಿ ಲೋನ್ಗಳಲ್ಲಿ ಓಲ್ಡ್ mode of paying the interest for a couple of years and paying their principal at the period of maturity ಇನ್ನೂ ಇದೆ. ಬಟ್ EMI ಸಿಸ್ಟಮ್ ಇದ್ದಾಗ ಏನಾಗುತ್ತೆ, EMI ಗೊತ್ತಿರಬಹುದು, EMI ಒಂದು ಇನ್ಸ್ಟಾಲ್ಮೆಂಟ್ ಏನ್ ಪೇ ಮಾಡ್ತೀವಿ ನಾವು, ಆ EMI ಅಲ್ಲಿ ಇಟ್ ಇನ್ಕ್ಲೂಡ್ಸ್ ಬೋತ್ ಇಂಟ್ರೆಸ್ಟ್ ಅಂಡ್ ಪ್ರಿನ್ಸಿಪಲ್ ಕಾಂಪೋನೆಂಟ್, ಎರಡನ್ನು ಸೇರಿಸಿ EMI ಅನ್ನ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡಿರ್ತಾರೆ. ಈಕ್ವೇಟೆಡ್ ಅಂದ್ರೆ ಈಕ್ವಲ್ ಆಗಿರುತ್ತದು. ಸೊ ಅದನ್ನ ಈಕ್ವಲ್ ಮಾಡಿರ್ತಾರೆ, ಇರಲ್ಲ, ಇಂಟ್ರೆಸ್ಟ್ ಮತ್ತೆ ಪ್ರಿನ್ಸಿಪಲ್ ಎರಡೂ ಅನ್ನು ಸೇರಿಸಿ ಈಕ್ವಲ್ ಅಮೌಂಟ್ ಅನ್ನ ಅವರು ಮಾಡಿರ್ತಾರೆ. ಬಲೂನ್ ಪೇಮೆಂಟ್ಸ್ ಅಂತ ಹೇಳ್ತೀವಿ. EMI ಹೇಗೆ ಸ್ಟ್ರಕ್ಚರ್ ಆಗತ್ತೆ ಅಂತಾನು ಹೇಳ್ತೀನಿ ನಿಮ್ಗೆ. EMI ಸ್ಟ್ರಕ್ಚರ್ ಯಾವ ತರ ಇರುತ್ತೆ ಅಂದ್ರೆ, ಇನಿಷಿಯಲ್ ಇಯರ್ಸ್ ಅಲ್ಲಿ ಇಂಟ್ರೆಸ್ಟ್ ಕಾಂಪೋನೆಂಟ್ ಜಾಸ್ತಿ ಇರುತ್ತೆ, ದ ಪ್ರಿನ್ಸಿಪಲ್ ಕಾಂಪೋನೆಂಟ್ ತುಂಬಾ ಕಡಿಮೆ ಇರುತ್ತೆ. ಹೋಗ್ತಾ ಹೋಗ್ತಾ ಏನಾಗುತ್ತೆ ಅಂದ್ರೆ, ದಿ ಪ್ರಿನ್ಸಿಪಲ್ ಕಾಂಪೋನೆಂಟ್ ಜಾಸ್ತಿ ಆಗುತ್ತೆ, ಇಂಟ್ರೆಸ್ಟ್ ಕಾಂಪೋನೆಂಟ್ ಕಡಿಮೆ ಆಗ್ತಾ ಹೋಗುತ್ತೆ. ಹಾಗಾಗಿ ಇಂಟ್ರೆಸ್ಟ್ ಮತ್ತೆ ಪ್ರಿನ್ಸಿಪಲ್ ಅನ್ನ ಹೆಚ್ಚು ಕಡಿಮೆ ಹೆಚ್ಚು ಮಾಡಿ ಅವರು ಈಕ್ವಲ್ ಆಗಿ ಅದನ್ನ ಬ್ಯಾಲೆನ್ಸ್ ಮಾಡಿರ್ತಾರೆ. ಅದಕ್ಕೆ ಇದನ್ನ ಈಕ್ವೇಟೆಡ್ ಅಂತ ಕರಿತೀವಿ. ಈಕ್ವೇಟೆಡ್ ಮಂತ್ಲಿ ರೀಪೇ ಮಾಡೋದ್ರಿಂದ ಇದನ್ನ ಮಂತ್ಲಿ ಇನ್ಸ್ಟಾಲ್ಮೆಂಟ್ ಅಂತ ಹೇಳ್ತೀವಿ. ಸೊ ದ ಲೋನ್ ಈಸ್ ರೀಪೇಡ್ on a monthly basis, and the repayment of loan includes both principal and interest component, hence it is called equated monthly installment. ಈ ತರ ನಾವು ರೀಪೇ ಮಾಡ್ತಾ ಇದ್ರೆ DSCR ಇದಕ್ಕೆ ಅಪ್ಲೈ ಆಗಲ್ಲ. DSCR ಫಾರ್ಮುಲಾ ನೋಡೋದಾದ್ರೆ EBIT ಅಂದ್ರೆ ಅರ್ನಿಂಗ್ಸ್ ಬಿಫೋರ್ ಇಂಟ್ರೆಸ್ಟ್ ಅಂಡ್ ಟ್ಯಾಕ್ಸಸ್, ಅಥವಾ ಸಿಂಪಲ್ ಆಗಿ ಪ್ರಾಫಿಟ್ಸ್ ಅಂತ ಹೇಳ್ಬೋದು. EBIT ಅಪಾನ್ ಬ್ರಾಕೆಟ್ ಇದೆ, ಇಂಟ್ರೆಸ್ಟ್ ಪ್ಲಸ್ ಪ್ರಿನ್ಸಿಪಲ್ ಅಪಾನ್ 1 minus tax rate. ಇಂಟ್ರೆಸ್ಟ್ ಆಸ್ ಇಟ್ ಇಸ್ ಮುಂಚೆ ತಗೊಂಡಂಗೆ EBIT ಬೈ ಇಂಟ್ರೆಸ್ಟ್ ಅದು ಬರುತ್ತೆ, ಅದರ ಜೊತೆಗೆ ಪ್ರಿನ್ಸಿಪಲ್ ಅಪಾನ್ 1 minus tax rate. One thing you need to keep in your mind, that is 1 minus tax ಏನು denominator ಇದೆ, this denominator is applicable only to the principal component. Interest is independent, so ಹಾಗಾಗಿ there is another bracket inside there. ಸೊ ಪ್ರಿನ್ಸಿಪಲ್ ಅಪಾನ್ 1 minus tax. 1 minus tax ರೇಟ್ ಯಾಕಪ್ಪ ಅಂತಂದ್ರೆ, ಇಂಟ್ರೆಸ್ಟ್ ಇರಲ್ಲ, ಪ್ರಿನ್ಸಿಪಲ್ ಗೆ ಟ್ಯಾಕ್ಸ್ ಅಡ್ಜಸ್ಟ್ಮೆಂಟ್ ಇರುತ್ತೆ. ಆ 1 minus tax ಡಿನಾಮಿನೇಟರ್ ತಗೊಂಡಾಗ ದ ಕ್ಯಾಶ್ ಔಟ್ಫ್ಲೋ ವಿಲ್ ಬಿ ಮೋರ್ ಫ್ರಮ್ ಪ್ರಿನ್ಸಿಪಲ್. ಇಂಟ್ರೆಸ್ಟ್ ಫಾರ್ ಎಕ್ಸಾಂಪಲ್, ಇಂಟ್ರೆಸ್ಟ್ 100 ಅಂತ ಕೊಟ್ರೆ 100 is equal to 100. ಪ್ರಿನ್ಸಿಪಲ್ ನೀವು 100 ಅಂತ ಕೊಟ್ರೆ ಆಕ್ಚುಯಲ್ ಕ್ಯಾಶ್ ಫ್ಲೋ ವಿಲ್ ಬಿ 100 ಪ್ಲಸ್ ದ ಟ್ಯಾಕ್ಸ್ ಆನ್ ಪ್ರಿನ್ಸಿಪಲ್ ಆಕ್ಚುಲಿ. ಸೊ ಎಷ್ಟು ಅಡಿಷನಲ್ ಕ್ಯಾಶ್ ಫ್ಲೋ ಹೋಗುತ್ತೆ ಅಂತ ನೋಡೋಕೆ ಪ್ರಿನ್ಸಿಪಲ್ ಡಿವೈಡೆಡ್ ಬೈ 1 minus tax ರೇಟ್ ತಗೊಂತೀವಿ, ಆವಾಗ ನಮಗೆ ಟೋಟಲ್ ಕ್ಯಾಶ್ ಔಟ್ಫ್ಲೋ ಗೊತ್ತಾಗುತ್ತೆ. ಯಾಕೆ ಈ ಡಿಫರೆನ್ಸ್ ಅಂದ್ರೆ, ನಾನು ಮುಂಚೆನೆ ಹೇಳಿದ ಹಾಗೆ ಇಂಟ್ರೆಸ್ಟ್ ಈಸ್ ಟ್ಯಾಕ್ಸ್ ಡಿಡಕ್ಟಬಲ್, ಅಂದ್ರೆ ಟ್ಯಾಕ್ಸ್ ಎಕ್ಸಂಪ್ಟೆಡ್. ನಾನು 100 rupees ಇಂಟ್ರೆಸ್ಟ್ ಅನ್ನ ನಾನು ಪೇ ಮಾಡಿದ್ರೆ, ಬ್ಯಾಂಕಿಗೆ ಪೇ ಮಾಡಿದ್ರೆ, ಐ ಡೋಂಟ್ ಹ್ಯಾವ್ ಟು ಪೇ ಟ್ಯಾಕ್ಸ್ ಆನ್ ದಟ್ 100 rupees. ಬಟ್ ಅದೇ ನಾನು 100 rupees ಪ್ರಿನ್ಸಿಪಲ್ ಅನ್ನ ನಾನು ಪೇ ಮಾಡಿದ್ರೆ, ಐ ನೀಡ್ ಟು ಪೇ 100 rupees ಪ್ರಿನ್ಸಿಪಲ್ ಪ್ಲಸ್ ಐ ನೀಡ್ ಟು ಪೇ 30% ಟ್ಯಾಕ್ಸ್ ಆನ್ ದಟ್ ಪ್ರಿನ್ಸಿಪಲ್. ಸೊ ಇಂಟ್ರೆಸ್ಟ್ ಈಸ್ ಟ್ಯಾಕ್ಸ್ ಎಕ್ಸಂಪ್ಟೆಡ್, principal is not exempted from the taxes. Hence, there is a difference between the way interest is taken and the principal is taken. The formula goes like this: EBIT upon bracket interest plus sub bracket principal upon 1 minus tax rate, bracket complete, and the whole bracket complete. So that is for the formula sake. ಈಗ DSCR of 5 times ಅಂತ ಬಂದ್ರೆ, ಬ್ಯಾಂಕರ್ ಯಾವ ದೃಷ್ಟಿಯಿಂದ ನೋಡ್ತಾನಂದ್ರೆ, ಈ ಕಂಪ್ನಿಗೆ ನಾನು ಸಾಲ ಕೊಟ್ರೆ, ಒಂದು 10 ಲಕ್ಷ 20 ಲಕ್ಷ ಸಾಲ ಕೊಟ್ರೆ, ಅವನು ಪ್ರಾಫಿಟಬಿಲಿಟಿ ಎಷ್ಟಿದೆಯಪ್ಪ ಅಂದ್ರೆ, ನನ್ನ ಇಂಟ್ರೆಸ್ಟ್ ಮತ್ತೆ ಅವನು ರೀಪೇಮೆಂಟ್ ಆಫ್ ಕ್ಯಾಪಿಟಲ್ ಅನ್ನ ಮಾಡಿದ್ರು ಕೂಡ ಅವನ ಹತ್ರ ಇನ್ನು 4 ಪಟ್ಟು ಪ್ರಾಫಿಟ್ಸ್ ಉಳ್ಕೊಳ್ಳುತ್ತೆ. ಹೈಯರ್ ದ ಡೆಟ್ ಸರ್ವಿಸ್ ಕವರೇಜ್ ರೇಷಿಯೋ, ಬೆಟರ್ ಇಟ್ ಈಸ್ ಫಾರ್ ದ ಕಂಪನಿ ಅಂತ ಕೂಡ ಹೇಳ್ಬೋದು. ಬೋತ್ ಇಂಟ್ರೆಸ್ಟ್ ಕವರೇಜ್ ರೇಷಿಯೋ, ಡೆಟ್ ಸರ್ವಿಸ್ ಕವರೇಜ್ ರೇಷಿಯೋ ಎಷ್ಟು ಜಾಸ್ತಿ ಇರುತ್ತೋ ಅಷ್ಟು ಕಂಪ್ನಿಗೆ ಒಳ್ಳೇದು. ಅದು ರೆಪ್ಯುಟೇಷನ್ ಅನ್ನ ಹೆಚ್ಚು ಮಾಡುತ್ತೆ, ಅದು ಅವ್ರಿಗೆ ಒಳ್ಳೆ ಟರ್ಮ್ಸ್ ಫ್ರಮ್ ದ ಬ್ಯಾಂಕ್ಸ್ ಅನ್ನ ಕೊಡುತ್ತೆ. ಐ ಹೋಪ್ ಕವರೇಜ್ ರೇಷಿಯೋಸ್ ಆರ್ ಕ್ಲಿಯರ್ ಟು ಯು. ನೆಕ್ಸ್ಟ್ ಅಂಡ್ ದ ಲಾಸ್ಟ್ ಕ್ಯಾಟಗರಿ ಆಫ್ ರೇಷಿಯೋಸ್ ನೋಡೋದಾದ್ರೆ, ಇಟ್ ಈಸ್ ಮಾರ್ಕೆಟ್ ಟೆಸ್ಟ್ ರೇಷಿಯೋಸ್ ಅಂತ. ಮಾರ್ಕೆಟ್ ಟೆಸ್ಟ್ ರೇಷಿಯೋಸ್ ಪಿಕ್ಯುಲಾರಿಟಿ ಏನಪ್ಪಾ ಅಂತಂದ್ರೆ, ದೀಸ್ ಆರ್ ಎಕ್ಸ್ಟರ್ನಲ್ ಟು ದ ಕಂಪನಿ. ನಾವು ಇಷ್ಟೊತ್ತು ಏನ್ ನೋಡಿದ್ವಲ್ಲ, ಲಿಕ್ವಿಡಿಟಿ ಆಗಿರ್ಬೋದು, ಸಾಲ್ವೆನ್ಸಿ ರೇಷಿಯೋಸ್, ಪ್ರಾಫಿಟಬಿಲಿಟಿ ರೇಷಿಯೋಸ್, ಟರ್ನ್ ಓವರ್ ರೇಷಿಯೋಸ್, ಅವೆಲ್ಲ ರೇಷಿಯೋಸ್ ಏನಿದೆಯಲ್ಲ, ದೇ ಆರ್ ಇಂಟರ್ನಲ್ ಟು ದ ಕಂಪನಿ. ಅಂದ್ರೆ ದೇರ್ ಈಸ್ ಅ ಕಂಟ್ರೋಲ್ ಓವರ್ ಸಚ್ ರೇಷಿಯೋಸ್. ಆ ರೇಷಿಯೋಸ್ ಅನ್ನ ನಾವು ಹೆಚ್ಚು ಮಾಡಕ್ಕೆ ಕಡಿಮೆ ಮಾಡಕ್ಕೆ ನಮ್ಮ ಹತ್ರ ಕೆಪಾಸಿಟಿ ಇರುತ್ತೆ. ಬಟ್ ಈ ರೇಷಿಯೋಸ್ ಏನಿದೆಯಲ್ಲ, ದೀಸ್ ಆರ್ ಎಕ್ಸ್ಟರ್ನಲ್ ಟು ದ ಕಂಪನಿ. the external factors influence these ratios. Hence the company may not have control over such ratios. ಏನಪ್ಪಾ ಇದರಲ್ಲಿ ಒಂದು ಪ್ರೈಸ್ ಅರ್ನಿಂಗ್ ರೇಷಿಯೋ ಅಂತ ಹೇಳ್ತೀವಿ. ವೆರಿ ಇಂಪಾರ್ಟೆಂಟ್ ರೇಷಿಯೋ ಯೂಸ್ಡ್ ಬೈ ಆಲ್ ದಿ ಇನ್ವೆಸ್ಟರ್ಸ್ ಇನ್ ದ ಸ್ಟಾಕ್ ಮಾರ್ಕೆಟ್ಸ್. ಪ್ರೈಸ್ ಅರ್ನಿಂಗ್ ರೇಷಿಯೋ PR ಅಂತಾನು ಕರೀತಾರೆ, P ಮಲ್ಟಿಪಲ್ ಅಂತ ಕೂಡ ಕರೀತಾರೆ. ಲಾರ್ಜ್ ಇನ್ವೆಸ್ಟರ್ಸ್, FIIs ಅಂತ ಕರಿತೀವಲ್ಲ, ಫಾರಿನ್ ಇನ್ಸ್ಟಿಟ್ಯೂಷನಲ್ ಇನ್ವೆಸ್ಟರ್ಸ್ ಅವರು ಅಥವಾ ಫಿನಾನ್ಷಿಯಲ್ ಇನ್ಸ್ಟಿಟ್ಯೂಷನ್ಸ್, ಮ್ಯೂಚುವಲ್ ಫಂಡ್ ಅವರು, ಅವರೆಲ್ಲ P ರೇಷಿಯೋನ ವೆರಿ ವೈಡ್ಲಿ ಯೂಸ್ ಮಾಡ್ತಾರೆ ಸ್ಟಾಕ್ ಮಾರ್ಕೆಟ್ ಅಲ್ಲಿ, ಕ್ಯಾಪಿಟಲ್ ಮಾರ್ಕೆಟ್ ನಲ್ಲಿ. ಅದು ಒಂದು ರೇಷಿಯೋ, ಡಿಸ್ಕಸ್ ಮಾಡೋಣ ಆಮೇಲೆ. ಮಾರ್ಕೆಟ್ ಕ್ಯಾಪಿಟಲೈಸೇಷನ್ ಇಸ್ ಅನದರ್ ಒನ್. ಅರ್ನಿಂಗ್ಸ್ ಈಲ್ಡ್ ಅಂತ ಇನ್ನೊಂದಿದೆ, ಡಿವಿಡೆಂಡ್ ಈಲ್ಡ್ ಅಂತ ಇನ್ನೊಂದಿದೆ. ದೀಸ್ ಆರ್ ಸಮ್. ನಾನು ಎಲ್ಲವನ್ನೂ ಲಿಸ್ಟ್ ಮಾಡಕ್ ಹೋಗಿಲ್ಲ, ಇಂಪಾರ್ಟೆಂಟ್ ರೇಷಿಯೋ ಅನ್ಸಿರೋದನ್ನ ಎಲ್ಲಿ ತಗೊಂಡಿದ್ದೀನಿ, ಮಾರ್ಕೆಟ್ ಟೆಸ್ಟ್ ರೇಷಿಯೋಸ್. PR ನೋಡೋಣ. ಪ್ರೈಸ್ ರೇಷಿಯೋ, PR ಅಥವಾ P ಮಲ್ಟಿಪಲ್ ಅಂತ ಹೇಳ್ತೀವಿ. PR ಪ್ರೈಸ್ ಅರ್ನಿಂಗ್ ರೇಷಿಯೋ ಇಸ್ ಈಕ್ವಲ್ ಟು ಮಾರ್ಕೆಟ್ ಅಂತ ಹೇಳ್ತೀವಿ. ಈಗ ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನೀಸ್ ನಾವು ಹೇಳ್ತೀವಲ್ಲ, ರಿಲಯನ್ಸ್, ಇನ್ಫೋಸಿಸ್, ವಿಪ್ರೋ, ಹಿಂದೂಸ್ತಾನ್ ಯೂನಿಲಿವರ್, ಪ್ರಾಕ್ಟರ್ ಅಂಡ್ ಗ್ಯಾಂಬಲ್, ಡಾಬರ್, ಕೋಲ್ಗೇಟ್, ಪಾಮೋಲಿವ್, ಇವೆಲ್ಲ ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನೀಸ್. ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನಿ ಅರ್ಥ ಏನಂದ್ರೆ, ದೀಸ್ ಆರ್ ದ ಕಂಪನೀಸ್ ವಿಚ್ ಆರ್ ಓನ್ಡ್ ಬೈ ದ ಜನರಲ್ ಪಬ್ಲಿಕ್. ಅಂದ್ರೆ the general public have invested into the share capital of these companies. Contrary to public limited companies, there are private limited companies wherein the investment into the capital of the company is not open to the general public. They are called private limited companies. Group of friends, group of relatives ಮಾತ್ರ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿರ್ತಾರೆ, ಅದನ್ನ ನಾವು private limited companies ಅಂತ ಹೇಳ್ತೀವಿ. There could be one common possibility of confusion here. ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಅಂಡರ್ಟೇಕಿಂಗ್ಸ್ ಅಂತ ಒಂದು ಬರುತ್ತೆ, ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಎಂಟರ್ಪ್ರೈಸ್ ಅಂತ ಬರುತ್ತೆ, PSU ಅಥವಾ PSE ಅಂತ ಕರಿತೀವಿ. ದಟ್ ಮೀನ್ಸ್ ದೀಸ್ ಆರ್ ದ ಗವರ್ಮೆಂಟ್ ಎಂಟರ್ಪ್ರೈಸಸ್. ಗವರ್ಮೆಂಟ್ ಎಂಟರ್ಪ್ರೈಸಸ್ ಅಂತ ಯಾವ್ದಕ್ಕೆ ಹೇಳ್ತೇವೆ, PSU ಅಥವಾ PSE ಅಂತ ಯಾವ್ದಕ್ಕೆ ಕರಿತೀವಿ ಅಂದ್ರೆ, wherein it is a company wherein the stakeholding by the government is to the tune of 50% or more. ಅಂತ ಕಂಪನಿಗಳನ್ನ ನಾವು ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಅಂಡರ್ಟೇಕಿಂಗ್ಸ್ ಅಥವಾ ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಎಂಟರ್ಪ್ರೈಸಸ್ ಅಂತ ಕರಿತೀವಿ. ಬ್ಯಾಂಕ್ ಆಗಿದ್ರೆ ಅದನ್ನ ನಾವು PSB ಅಂತ ಕರಿತೀವಿ, ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಬ್ಯಾಂಕ್ ಅಂತ ಕರಿತೀವಿ. In all these types, the stakeholding by the government, either state government or central government or combination of state and central government together, is going to be for 50% or more than 50%. The examples ನೋಡೋದಾದ್ರೆ IOC ಇದೆ, ಇಂಡಿಯನ್ ಆಯಿಲ್ ಕಾರ್ಪೊರೇಷನ್ ಇದೆ, HPCL ಇದೆ, ಹಿಂದೂಸ್ತಾನ್ ಏರೋನಾಟಿಕ್ಸ್ ಲಿಮಿಟೆಡ್ HAL ಇದೆ, ಸುಮಾರು ಕಂಪನಿಗಳು. ಏರ್ ಇಂಡಿಯಾ ಇಸ್ ಅ ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಅಂಡರ್ಟೇಕಿಂಗ್. ಸೊ ಅಲ್ಲಿ ಸೆಂಟ್ರಲ್ PSUs ಮತ್ತೆ ಸ್ಟೇಟ್ PSUs ಅಂತ ಹೇಳ್ತೀವಿ. ಓಕೆ, ಸೊ ಅದು ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್. ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನಿ ಅಂದ್ರೆ ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಅಂಡರ್ಟೇಕಿಂಗ್ ಆರ್ ಪಬ್ಲಿಕ್ ಸೆಕ್ಟರ್ ಎಂಟರ್ಪ್ರೈಸ್ ಮೀನ್ಸ್ ಇಟ್ಸ್ ಅ ಗವರ್ಮೆಂಟ್ ಎಂಟರ್ಪ್ರೈಸ್. ಗವರ್ಮೆಂಟ್ ಅಂದ್ರೆ ನೀಡ್ ನಾಟ್ ಬಿ 100% ಸ್ಟೇಕ್ ಹೋಲ್ಡಿಂಗ್, 50% ಆರ್ ಮೋರ್ ದನ್ ದಟ್, ಅದು PSU ಅಥವಾ PSE. ಇನ್ನೊಂದು ಕ್ಯಾಟಗರೈಸೇಷನ್ ನೋಡಿದ್ರೆ ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನಿ ಅಂಡ್ ಅ ಪ್ರೈವೇಟ್ ಲಿಮಿಟೆಡ್ ಕಂಪನಿ ಅಂತ. ಓಕೆನಾ? ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನಿ ಅಂದ್ರೆ it is a company wherein the general public have invested into the capital of the company. Examples: Infosys, Wipro, Reliance, day to day ನೋಡ್ತೀವಲ್ಲ, all these are public limited companies. All general public, ನಾನು ನೀವು ಕೂಡ ಇನ್ವೆಸ್ಟ್ ಮಾಡಬಹುದು ಈ ಕಂಪನಿಗಳಲ್ಲಿ. ಪ್ರೈವೇಟ್ ಲಿಮಿಟೆಡ್ ಕಂಪನಿ ಅಂದ್ರೆ ಈ ಕಂಪನಿಗಳಲ್ಲಿ ಇಂಥ ಕಂಪನಿಗಳಲ್ಲಿ ಜನರಲ್ ಪಬ್ಲಿಕ್ ಗೆ ಇನ್ವೆಸ್ಟ್ ಮಾಡಕ್ಕೆ ಅವಕಾಶ ಇರೋದಿಲ್ಲ. ಇನ್ನೊಂದು ಡಿಫರೆನ್ಸ್ ನೋಡೋದಾದ್ರೆ, ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನೀಸ್ ಸ್ಟಾಕ್ ಎಕ್ಸ್ಚೇಂಜ್ ಅಲ್ಲಿ ಲಿಸ್ಟ್ ಆಗಿರುತ್ತೆ. ಲಿಸ್ಟಿಂಗ್ ಇಸ್ ಮ್ಯಾಂಡೇಟರಿ ಫಾರ್ ದ ಪಬ್ಲಿಕ್ ಲಿಮಿಟೆಡ್ ಕಂಪನೀಸ್, ವೇರ್ ಆಸ್ ಪ್ರೈವೇಟ್ ಲಿಮಿಟೆಡ್ ಕಂಪನೀಸ್ ಆರ್ ನಾಟ್ ಲಿಸ್ಟೆಡ್ ಆನ್ ದ ಸ್ಟಾಕ್ ಎಕ್ಸ್ಚೇಂಜಸ್. ಸ್ಟಾಕ್ ಎಕ್ಸ್ಚೇಂಜ್ ಲೈಕ್ ಬಾಂಬೆ ಸ್ಟಾಕ್ ಎಕ್ಸ್ಚೇಂಜ್, ನ್ಯಾಷನಲ್ ಸ್ಟಾಕ್, BSE, NSE ತರ ಇರುತ್ತೆ. ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ ಪರ್ ಇಕ್ವಿಟಿ ಶೇರ್ ಅಂತ ಫಾರ್ಮುಲಾದಲ್ಲಿದೆ, ಅದಕ್ಕಾಗಿ ಈ ಬ್ಯಾಕ್ ಗ್ರೌಂಡ್ ಹೇಳ್ಬೇಕಾಯ್ತು. ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ ಪರ್ ಇಕ್ವಿಟಿ ಶೇರ್ is decided in the market on BSE and NSE, and this changes on a daily basis. ಪ್ರತಿದಿನ ಚೇಂಜ್ ಆಗ್ತಾನೆ ಇರುತ್ತಿದ್ದು. As on today, what is the market price of one equity share? ಅದನ್ನ upon earnings per share. Earnings per share ಅಂದ್ರೆ total profits earned by the company is distributed among profit ಆಗಿದೆ 1000 shares ಇದೆ company share in the profits of the company for one equity share ಎಷ್ಟು ಬರುತ್ತೆ ಅಂದ್ರೆ total profit is 10,000 divided by number of shares is 1000. 10,000 upon 1000 is equal to 10 rupees 10. earnings per share is rupees 10. ಅದರ ಅರ್ಥ ಒಂದು equity share ಗೆ 10 ರೂಪಾಯಿ ಲಾಭ ಆಗಿದೆ ಅಂತ ಅದನ್ನ ನಾವು earnings per share ಅಂತ ಹೇಳ್ತೀವಿ. ಸೊ ಫಾರ್ಮುಲಾ ಬರೋದಾದ್ರೆ ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ ಪರ್ ಇಕ್ವಿಟಿ ಶೇರ್ ಅಪಾನ್ ಅರ್ನಿಂಗ್ಸ್ ಪರ್ ಶೇರ್ ಇಪಿಎಸ್. ಏನ್ ಹೇಳುತ್ತೆ ಇದು? ದಿಸ್ ಟೆಲ್ಸ್ ಅಸ್ ದ ಮಾರ್ಕೆಟ್ ರೆಸ್ಪಾನ್ಸಿವ್ನೆಸ್ ಟು ದ ಅರ್ನಿಂಗ್ಸ್ ಪೊಟೆನ್ಶಿಯಲ್ ಆಫ್ ದ ಕಂಪನಿ ಅಂತ ಹೇಳ್ತೀವಿ. ದ ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ ಈಸ್ ಸೆನ್ಸಿಟಿವ್ ಟು ದ ಅರ್ನಿಂಗ್ಸ್ ಅಂತ ಹೇಳ್ತೀವಿ. ಫಾರ್ ಎಕ್ಸಾಂಪಲ್ ಪಿ ರೇಷಿಯೋ ಇಸ್ ಈಕ್ವಲ್ ಟು ಒಂದು ಇಲ್ಲಿ ಎಕ್ಸಾಂಪಲ್ ತೋರಿಸ್ತೀನಿ ನೋಡಿ. ಪಿ ರೇಷಿಯೋ ಆಫ್ 10 times, ಪಿ ರೇಷಿಯೋ ಆಫ್ 20 times, ಪಿ ರೇಷಿಯೋ ಆಫ್ 100 times ಅಂತ ಹೇಳಿದೆ. Does high P ratio indicate a good performance? Reason for the P ratio to go up or down ಇದನ್ನ ನಾವು ನೋಡಿದಾಗ ಅರ್ಥ ಆಗುತ್ತೆ. P ratio of 10 times ಅಂದ್ರೆ ಏನು ಇದನ್ನ ಮೊದಲು ಅರ್ಥ ಮಾಡ್ಕೊಳ್ಳೋಣ. P ratio of 10 times ಅಂದ್ರೆ for 1 rupee of earnings per share 10 rupee is the market price of equity share. ಹಿಂದಿನ ಸ್ಲೈಡ್ ಅಲ್ಲಿ ಹೇಳಿದ್ರೆ ರೆಸ್ಪಾನ್ಸ್ ಆಫ್ ದ ಮಾರ್ಕೆಟ್ ಟುವರ್ಡ್ಸ್ ದ ಅರ್ನಿಂಗ್ಸ್ ಆಫ್ ದ ಕಂಪನಿ ಅಂತ. ಅಂದ್ರೆ ನೀವು 1 ರೂಪಾಯಿ ಅರ್ನ್ ಮಾಡಿದ್ರೆ ಕಂಪನಿ 1 ರೂಪಾಯಿ ಇಪಿಎಸ್ ಇದ್ರೆ ಮಾರ್ಕೆಟ್ ಈಸ್ ರೆಡಿ ಟು ಇನ್ವೆಸ್ಟ್ ಅಪ್ ಟು 10 rupees ಅಂತ ಅದರ ಅರ್ಥ. 20 times ಅಂದ್ರೆ ಫಾರ್ ಪ್ರಾಫಿಟ್ ಆಫ್ 1 rupee that you have earned, market is investing 20 rupees per share. 100 times ಅಂದ್ರೆ for 1 rupee of profit earned by the company, market is ready to give its response by 100 rupees ಅಂತ ಇದರ ಅರ್ಥ. Does high P ratio indicate a good performance? Definitely yes ಅಂತ ಹೇಳ್ಬೋದು. Higher the P ratio ಯಾವಾಗ ಆಗುತ್ತೆ? EP for a given level of earnings per share, the market price increase ಆದಾಗ P ratio ಜಾಸ್ತಿ ಆಗುತ್ತೆ. So high P ratio is good for the company, but not always. Conditions apply. ಆ conditions apply ಅನ್ನ ನಾವು ತುಂಬಾ ಕಾಶಿಯಸ್ ಆಗಿ ನೋಡ್ಬೇಕಾಗುತ್ತೆ. ಅದನ್ನ ಎಕ್ಸ್ಪ್ಲೇನ್ ಮಾಡ್ತೀನಿ ನಾನು. ರೀಸನ್ಸ್ ಫಾರ್ P ratio ಟು ಗೋ ಅಪ್ ಆರ್ ಕಮ್ ಡೌನ್ ನೋಡಿದಾಗ ಆ ಕಾಶನ್ ಅನ್ನ ನಾನೇನು ಹೇಳಿದ್ನಲ್ಲ ಅದು ನಮ್ಗೆ ಅರ್ಥ ಆಗುತ್ತೆ. ಈ ಫಾರ್ಮುಲಾ ನೋಡೋದಾದ್ರೆ ಫಸ್ಟ್ ಬುಲೆಟ್ ಪಾಯಿಂಟ್ ಅಲ್ಲಿ ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ ಪರ್ ಇಕ್ವಿಟಿ ಶೇರ್ ಅಪಾನ್ ಇಪಿಎಸ್ ಇದೆ. ಓಕೆನಾ? ಈಗ ಲೆಟ್ ಮಿ ಯೂಸ್ 1 or 2 calculations here. ಫಸ್ಟ್ ಇಯರ್ಗೆ ಪಿ ರೇಷಿಯೋ ಇಸ್ ಈಕ್ವಲ್ ಟು 10 times ಇದೆ. ಸೆಕೆಂಡ್ ಇಯರ್ಗೆ the P ratio is equal to 20 times ಇದೆ. Now the question to the participants, P ratio has increased from 10 times to 20 times from first year to second year. Is it good or is it not good? Question to the participants. This is very important ratio, so I want to spend a little time here. In ಉಳಿದಿರೋ ratio ನಾವು ತುಂಬಾ ಜಾಸ್ತಿ ಹೊತ್ತು ಸ್ಪೆಂಡ್ ಮಾಡಲ್ಲ. So ಹಾಗಾಗಿ I want your response for this ratio. Is it good for the company if the P ratio is increased from 10 to 20 in 2 years span? So somebody said it is good. Wani has said it is good. Okay, let me show you this. How the P ratio has gone up anta nododadre first year ಅಲ್ಲಿ let me use an Excel sheet. Give me a minute. I'm typing something here.
Hello?
So just a second, I'm typing something in the Excel sheet. I'll share that Excel sheet with the participants.
Sure, sir. Sure, sure. Right.
Sir, is the Excel sheet visible now? Hello, sir. Is the Excel sheet visible? I have shared the Excel sheet now.
Yes, sir. It is visible.
Visible. Yeah, to the participants now. Look at this. I gave an example of the P ratio increased from 10 times to 20 times from first year to second year. Let's look at the intricacies of the increase in the P ratio. First year, and the EPS was rupees 10, hence the P ratio was 10 times, because the formula is very simple: market price per share divided by EPS. So 100 upon 10 is equal to 10 times. In the second year, P ratio has increased to 20 times, colored with yellow. But look at this, the market price share did not change in the second year. Market price per share remained rupees 100, and EPS has changed from rupees 10 to 5. 100 upon 5 is equal to 20 times. The P ratio has increased from 10 times to 20 times. Now, over to the participants. When the P ratio has increased from 10 times to 20 times, is it a better performance in the second year for the company? Looking into the intricacies of the increase and decrease in the market price and the earnings per share, there is increase in PE ratio. Is it a good sign, or is it not a good performance by the company? Considering only this example. Just a second. Yeah, one of the participants says it's a bad performance. It's very simple. Yeah, because EPS decreases. Yeah, P ratio has increased. P ratio, price earning ratio has increased, but see what has happened with the market price of equity share has not changed. Earnings per share